Same. I'm also joined.
You also were in Aziz's class. Okay. So what made you come here? Just again for you, sir. I haven't seen so many committed students like you all, but you're not studying at home. Okay. So what I'm going to do today is assume that this is an exam. Okay, but we discuss. That's the only difference. You're not going to do it by yourself. We can discuss. So in that sense, what I'm planning to do, or what I generally do is, now we have 3 hours and 15 minutes in your paper. So when you have 3 hours and 15 minutes, how do you allocate your time? Very simple. Let's assume 3 hours, 15 minutes reading or whatever. So 3 hours, that's 180 minutes. 180 minutes divided by 100 marks, 1.8 minutes per mark, which means each 2-mark question you have only 3.6 minutes. So you need to allocate your time accordingly, right? So section A. So when you say section A, you have 3.6 minutes per question into 15 questions, right? So that's that amount of time that you can spend. Let's roughly say around 45 minutes. If you take 3 okay. Then you have section B, which is again 3.6 minutes each question into again 15 questions. So let's roughly say around 45 minutes. So you spend 1.5 hours here. Then section C, you have 3.6 minutes, or rather now it's 20 marks, so 36 minutes into 2 questions. Let's say 1 hour, 10 minutes. So let's say 1 hour, 10 minutes. So altogether, you can finish this paper in 2 hours and 45 minutes you can finish. So there is additional 15 minutes and they give additional 15 minutes also. So there is enough time. So if you go to the exam and you realize that you don't have enough time to do the paper, there is something technically wrong with you. Okay? No. So you have 15 minutes here remaining. And then you have additional 15 minutes. This additional 15 minutes, what do? You can read the paper now. Only for the instructions. 15 minutes only instructions. When we were doing it, we could read the paper, but now I think they restricted that also. Just trying to open up the paper on this so it's easier. Did I send the mock 2 on the group? No. Okay. So what I tell students, this can be a different opinion. Your Ms. Aziza would have given you a different opinion. I don't know. She was also one of my students, and she got a Sri Lankan prize. She did with me. Way back in 2016. Anyways, irrelevant. So my strategy to answer any paper, any ACCA paper. This is not only for FM, but any paper. Lot of lecturers disagree with me, so I don't know what Aziza will say. You ask her, work backwards. Work backwards. Now, I remember we were at a ACCA panel discussion 2 years back, and then the students could pose questions, and we had lecturers from different institutes. So me and then 2 other people or 3 other people, and it happened to be that 2 of those were my lecturers also. So a student actually asked them, how do you tackle the questions at the exam, or what do you think we should do at the exam? So everyone gave their opinion, and I was last to come into that question. So what I told was, I always encourage students to start from section C. 2 reasons. One is, you already know what is coming in section C. Correct? No? So there are 4 main areas that will come in section C. One is your NPV analysis, one is your working capital management, one is your business finance and cost of capital, the other is your business valuations. But in my class, I told assume 5, put risk management also into it. Right? So these 5 can definitely come into section C. So before you go to the exam, you know what is coming. So out of those 5, 2 have to come. So let's say you master 5, all 5 you master. Then you go to the exam. Already you know these 2 questions I'm very familiar with. I definitely can answer. That is one reason. The second reason I'll come to later. After you do section C, obviously when you're doing section C, you have 2 questions. So I will show how you pick the questions now also. You will have a question that you're very comfortable with. For example, if you get NPV, everybody is comfortable with that. No, there can't be tricky adjustments. Everything you have learned now. So generally, students will pick or start off with NPV. Why? It gives some confidence. You need some confidence booster to say, okay, I know what I am doing. I can do it. Right? So then you start with those easy questions. Then you start the next, let's say, uncomfortable question. Let's say, for example, business valuations can be a little tricky sometimes. So then, okay, do I do business valuations? Okay, I do business valuations. I complete section C. Sometimes you will take more than 1 hour, 10 minutes. Don't worry. Right? Don't worry. Then you go to section B. Now, what is section B? You have 3 small cases. Based on those cases, you will have objective type questions. So when you have objective type questions, what will happen? You can obviously read the scenario, tuck, tick, tock, do the answer, 3.6 minutes each question, 45 minutes to finish that section. Then you move to section A. Now, why do I tell students to do section A last? Is because each 15-mark question, each 2-mark question is independent of the other. There is no dependency between question 1 and 2. Now, section B, there is a dependency. You read a paragraph. If you get the first one wrong, probably the second one is also going to be wrong. So there is a dependency. But section A is independent. Each question is independent of the other. Let's say you spent 2 hours in section C. Let's say 45 minutes in section B. Assume. Can happen at the exam. Then you have only 15 minutes for section A. No problem. Right? Independent of each other. Even if you tuck, tick, took, 1 in 4 chance your answer is correct. There's a 25% chance that your answer is correct. It's a lucky day for you. You will hit the sweet spot in all of those 15 questions. Very simple. But if you work reverse, you start from section A, what will happen? Out of excitement, you want to get everything correct. No? You spend 1 hour here, 1 hour here, then you have only you have less than 1 hour, you have 1 hour here, but not enough time. Because you will take more than 1 hour in section C. You can't do a tuck, tick, took there. You can't randomly get 2 marks. You can't just put a tick in one box and get 2 marks. Now here, section A, if you are lucky, without even reading the question, you can close your eyes and put a tick. The answer is correct, you get 2 marks. Examiner doesn't care how you got it correct. Nobody shows working. Right. So what I say is start from section C, then go to section B, then go to section A. Like I told you to, I don't know what you want to do. You can decide whether you want to listen to Aziza or me. That's your choice. Huh? But my students will listen to me. I believe so. Okay, so with that, let's go into section C. I don't even read section A, B, because you know why? If I read section B and if I see a question that I'm not comfortable with, for example, let's say something like foreign exchange risk management. I love it. This thing, student's perspective. I'm not comfortable with it. Student says. Then throughout the question, he's thinking, I have that question, how do I do it? How do I do it? How do I do it? Mindset. That's why I always tell students, go to the exam, enjoy the exam. I always tell students, enjoy the exam. Ask these guys. So go to the exam and you feel like I'm walking in the park. Which park? I don't know. Jurassic Park or Viharamadari Park, you have to decide. Right? But you go to the park and you walk casual, like you're going to the beach, No stress. I tell my students, I used to go 5 minutes late for the exam. You don't do that. Huh? That's my strategy. I go 5 minutes late because if I go early, let's say I go 5 minutes early, everybody comes to me, Nabil, what is this formula? How to do this question? What is this theory? It's nonsense. I also forget what I do. So I go late, 5 minutes late. I just go to the exam straight, sit. And then after I finish half the paper, I get up, I go for the washroom break and loaf around a little bit and come back and sit. Now, people always ask me, Nabil, how do you have time to do this? Preparation. You have to be mentally prepared to do your exam. I always tell students, you know what is coming in section C. You have to have the answer ready before the question is thrown at you. You have to have the answer ready. What I used to do is I used to look at these questions. Now, for example, critically discuss how N company could improve the management of its trade receivables. If I know the answer to this, only thing examiner has to give the question to me. I write the answer. So what I do is I look at these section C questions, these 10-mark questions. I write my own answers at home. That's what I do. I write my own answers at home. Or I read answers of examiners. Two things you can do. I have the Kaplan kit. Go to the back. Read all the section C answers. Read. 2-3 times you read. Okay. Definitely you will get through. Even if you don't have time to write. You are not working, you can write. You are working. Then you read. On the way to work and from back to work, you read. Read the answer. 10 times, 15 times you read. Right? It's a bad thing for me to tell this in class and in recording also. But that's how I studied AFM. Not AFM, APM. I didn't have time to go for class because I was working. And I had paid for the exam and then realized, okay, now 2 weeks for the exam. Now 1 week for the exam. Still I have not studied. I don't even know what is in the syllabus. What I did, I picked up the past papers. I read all the answers 4-5 times. Every paper I read 4-5 times. I read, that's all. No time to write and all. Went to the exam, I did the same thing. I passed. I think I got 60 or something. That's good score for AP. Okay. So don't discount the fact that when you read, you absorb knowledge. And when you're reading, don't press and read. Now, when you see a news article come on your phone or you read a funny story on your phone, will you ever forget it? Why? Because you're just casually reading, no stress. You're trying to understand the story. That's it. But when you're studying, what you're trying to do is your mind is telling you, somehow, bloody hell, need to remember this thing. Okay, if you read in that mindset, you're under stress. You will never remember also. Just understand what the examiner is saying. Read his report, understand what he's saying, see if there's a pattern, right? Compare 2 questions and see what has he done different. And then write those things in the exam. Okay. Right. So now we have this question. I came straight to section C. I didn't even know what is in A and B. Yeah? That's my strategy. I'm showing you how to do the paper. Now they are saying this is when you look at the question, what does it look like? I know obviously what it is, but what does it look like? This is a working capital management question. Put the topic on top. So this is working capital management question. WCA. Working capital management. Now you have to evaluate and tell me, are you comfortable with working capital management or you think that working capital management is equal to going to hell? That is your choice. I don't know what you feel. Okay, I don't know about what you feel. But for me, of course, obviously, all of this have to be comfortable. I can't be here. Okay, now don't do anything. Now go to the next question. What is the next question? Calculate the net present value of the investment project and discuss how capital asset pricing can make a better investment decision. Now, what is this question? NP. Now, you have to decide what you want to do first. Mind you, the first question you do, try to secure 16 to 18 marks. Now, why I tell you this is, let's say you secure 16 to 18 marks in this question and you secure 12 to 14 marks in this question. Okay. So, let's assume you went 12 on this, you went 18 on this. How many marks? 30. How many marks to pass? 50. How many marks remaining? 60. 60 marks remaining. Section A and B, 60 marks remaining. How much more to get? 20, man. 20 marks only out of 60. How difficult is it? Not difficult. Not difficult at all. Okay, so just trust me. Process will work. I don't know about you whether you want to trust me. That's your choice. But these two will trust me. and these people will trust me. Okay. Asmat, okay. Alive now? Breathing. Shall we start? Okay. Then no break, huh? I already gave half an hour break in the morning. Huh? Before we start, you asking break. Before we start, I told you no break. Okay, make yourself comfortable. Because I don't have a laptop. Okay. Okay, so what do you all want to start with? NPV or working capital? You all tell me. I'm okay with both. NPV, okay. Now, when you are doing the NPV, what are you going to do? First, read the requirement. Calculate NPV of the investment project in nominal terms. Okay, nominal terms. And what I always tell students is, when you go to the exam, if there is a word called and, highlight it. I'll tell you why. Because when you see these 12 marks, you are definitely going to be happy. I can definitely score 12 marks. That's your strategy. I can score 12 marks. That's why you pick this question. But you won't score 12 marks. Why? Because you forgot and. Because when you say and, it's like a plus. It's like a plus. Which means you have to do this part plus comment. The commenting, students forget. 1 mark for commenting. Just writing a comment. 1 mark. But students forget. They get so excited with doing this working. They feel so happy and relieved. Oh my God, I'm going to get 12. So you won't get 12. Don't be happy also. Okay. Right. So let's start. I'll try to load an Excel here. That's why I need this laptop, because I can't keep referring the question back and forth. Okay, so let's go to this question. The AC is hot. Can you reduce it? Very warm. Okay, let's read through the question. Let me load the Excel. Okay, so this is mock mock 2 section C. Okay, so we are doing question number 32. Okay, I will discuss. You can obviously do your working also. So it says Hayback is preparing to launch. Let me read from this. Hayback is preparing to launch a new product in a new market, which is outside its current business operation. That is important. Outside its current business operations. Can someone tell me why this is important? Why is this important? Sorry? Can't hear you. To identify the business risk. So ideally what it means here is your business risk is changing. Business risk is changing. Now, I don't know if you all have got this, but I tell my students, generally there is a matrix. Okay? Generally there is a matrix. You have financial risk and you have business risk. The finance risk can remain the same or change. Your business risk can remain the same or change. Okay. If your financial risk is the same, business risk is the same, there is no change, you can evaluate your projects using WACC. Okay. If your financial risk remains the same, but business risk changes, we do something called risk adjusted cost of capital. That is your 3 steps: de-gearing, re-gearing, and using capital. Okay. If it changes, we can use marginal cost. Sometimes we use APV, but this is out of your scope. This is AFM. So don't worry. These two is what you need to focus. Now, the moment you read outside its current business operations, what you have to understand is when I put it on my matrix, it sits here. which means I need to consider risk adjusted cost of capital somewhere, right? Maybe it's not in part A, maybe part B theory also. Okay, just keep that in mind. The company has undertaken market research, test and test marketing at a cost of 500,000. Now, is this 500,000 relevant? Not relevant. Sunk. Why? Has undertaken. Past. As a result of which it expects a new product to be successful. Feedback plans to charge a lower selling price initially and then increase the selling price on the assumption that the new product will establish itself in the new market. Forecast sales units, selling price and variable costs are as follows. So sales units are given 200, 800, 900, in the last year 400. Selling price and variable costs are given here in current price terms. What does that mean? Today's terms or real terms. No inflation recorded. Before taking account of forecast selling price inflation of 4% and variable cost inflation of 5% per year. So what do you need to do now? Inflate this by 4% and 5%. Simple stuff. Incremental fixed cost of 500,000 per year in the current price terms, again current price terms, would rise or arise as a result of producing the new product. Fixed cost inflation of 8% per year is expected. So you want to inflate it at 8%. Initial investment cost of production equipment for the new product will be 2.5 million, payable at the start of the first year of operations. Now, why is that important? Very good. So this is relevant for tax allowable depreciation. Why? Because if it says start of the first year of operation, your first tax allowable depreciation will be computed at the end of year 1. If it says end of year 0, then it says first tax allowable depreciation will be in year 0. So you need to get the timing correct. Production will cease at the end of 4 years because the new product is expected to have become obsolete due to new technology. The production equipment would have a scrap value at the end of 4 years for 125,000 in future value terms. So when you say future value terms, don't have to inflate nothing. Investing in working capital is 1.5 million at the start of the first year of operation. Working capital inflation is 6% per year, and working capital will be recovered in full at the end of 4 years. Quebec pays corp tax 20% per year, with tax liability being settled in the year in which it arises, so not in arrears. Company can claim tax allowable depreciation on 25% reducing balance basis, adjusted in the final year of operation for a balancing allowance or charge. Quebec company has a nominal after tax weighted average cost of capital of 12% and real after tax WACC of 8.5%. Which one do you use? Since they are asking to calculate in nominal terms, you have to use 12%. The company uses its current WACC as the discount rate for all investment projects. Now, is that correct? Is that correct? Is that correct? Hello, I'm talking to you. Is that correct? Maybe. So, what do you think? Is that correct? Now, what I told you, you can't use for all, no? When your business risk is changing, you can't simply use a WACC. You have to do a risk adjusted cost of capital. Right? So, always ensure that this is at the back of your mind. As and when relevant, you have to talk about it. Okay. Now, you don't have to draw this matrix at the exam, but keep that in mind and write the answer based on that. That's what section B is asking. We'll discuss later, I think. Okay, so let's start. So we'll go straight into NPV computation. So we can say NPV computation. It's not you watch, I do. Huh? You also have to do. Okay, so start your NPV computation. Then we'll. Okay. Yes. I'll put it on WhatsApp. Send it to you. month, is this a different mock to the last one? Yes, this is a different. The subject is very easy, huh? You can't fail. Okay, thank you. Okay, start working on it. I'll give you 10-minute head start. Huh? Then I'll start this. You can always do your workings within the same cell. So do. Don't wait for me. Huh? I'm giving you a head start. You've got a good head start. So we're going to start, well, I'm going to start rather, and then we can come here. This is, Plug that here. Say equals. Always do the linkings. In case you do one mistake and you correct it, you change a lot of things. Make sure you link your cells. Okay, done. So then you can bring in your investment of 2.5 million. And along with that, I'll put the disposal. Then we need to do working for working capital also. They say it's going to inflate by the same inflation. So let's wherever applicable, just copy and paste. Don't waste time. Working cap required. So India not 1.5 million. It's going to inflate by 6%. You will only consider the incremental. So ideally in year 4 you will not need it. Make sure that by year 4 your project is over. So you can again link your working capital. Then take summation. Then calculate percentage. Calculate NPV. That's your XP. 11,984,200. Make sure you got that answer. No. Doing. Traffic okay. You didn't get that? Is it wrong? Take 800,000 into 9, and then 1.05 to the power 2, right? Check your formula. What have you put? Read your formula. I'll tell you what's wrong. What have you put at the formula? Huh? 7.6. What is your formula? Read your formula. Yeah? No formula. How do you get the number? You got it without formula. How? How can you get without formula?
So can you use revenue minus variable cost that contribution base?
You can if you want. They won't give you a mark for doing it. They won't. Yeah.
So for the inflation, you did the main inflation itself, right?
Yeah. That is what is expected. You can do another working, but it will just take a lot of time. Yeah. I give you this question, you can finish in 5 minutes. Yeah, I finished in 5 minutes. Okay. Do it, I'll wait for you. This is for you, no, not for me. I don't get any happiness doing it. Finished. Problem still. Mr. I don't know your name. Asmat. Finished.
Yes. Who starts it?
No, you don't get the NPV.
I'm still in it. Yes.
Where are you going wrong? Working capital. What's wrong with working capital?
Starting here. Zero here. Working capital starting. Here, zero.
They say working capital has to be there at the beginning of the year. Look at that last line.
Beginning of the next year.
First year of operation. So, beginning of the first year means end of the last. 0. Okay.
Then it's ending year 3, right? Then give it an answer year 3.
Working capital ends in year 3, year 4 you recover the entire. Because you need only 4 years of working capital. So year not you put the money to fund year 1. Year 1 you put the money to fund year 2. Likewise. Last year you don't need to put any money. That's here. Year 4. And then you release all your working capital in year 4. Okay. Okay. Ashif, okay. So what is part B saying? Part B is asking us for, sorry, we didn't get the 12 marks. You did write the and part, no? What is the and? Comment on the financial acceptability. So you have to write a comment which will then say, since NPV is positive, since NPV is positive, the project is, what is it? Financially viable or feasible. Right? Financially feasible. Don't say feasible, you have to say financially feasible. Because you have not done a non-financial analysis on this. You don't know whether you have sufficient resources. You don't know whether you have even a government approval to run this project. Right? So it's financially feasible, but it's actually feasible, we do. Right. Part B discussed how the capital asset pricing model can assist feedback in making a better investment decision with respect to its new product launch. Now here theory and application is important. One is you need to know theory. Theory is what I taught you in that matrix that I gave you. Then what is the practicality or application of that theory into this question is for you to recognize what we recognized at the beginning of the question, where it said that this is different or outside its current business operations. So that is the trigger point. What students will do is they will then look at this section B question and they will say, this is what students will generally do. Okay? They will say, capital asset pricing model can help them to calculate NPV because it will help to calculate the discount rate. Because it will use beta, it will use risk, it will use that, it will use this, then explain everything about capital. You will walk out expecting 8 marks, you might get around 3 marks. Right? So all what you written rubbish, 3 marks. 3 marks. So you know what to write, how to write, and how to apply to the case. Very important. Okay, and don't leave these 8 mark questions. Sometimes students tell me, I don't know if you all have this problem, or this is what general students tell me, you all might be smarter than them. They say, sir, how do we start the question? Have you had that problem? You can always write something. You know how to start a question, no problem. No? Then okay. But generally, if you have a problem, for those online and not asking questions, but what I would suggest is pick a few words from the question and write those same words in your answer. For example, here it says discuss how the capital asset pricing model can assist feedback in making better investment decisions with respect to its new product launch. So if I didn't know how to start, what is the first word I want to write? I don't know. So what I would do is I would maybe start, okay, the capital asset pricing model can. When you say can, you have to write something after that. Then you will start automatically writing something. It might not make sense. The first line might not make sense, but after that you start building. Okay, so how do we answer this question? Because they say discuss. What does discuss mean? Okay, but simply writing pros and cons might not help, but you're relating to the case. So you have to discuss in respect to the case the pros and cons of using capital asset pricing model. But very important, you have to understand the last line with respect to its new product. Okay, I would suggest you take one step before this, especially in a question like this, one step before this, and address the problem the question has done. Because if you look at the last line of the case, it says WACC is the discount rate for all investment projects. Refer the case, take words out of it, put it into section. If I was you, I would start from that point. First, say what is the problem that is happening. This is important. When you're discussing something, there has to be a problem statement. There has to be a problem statement. What is my problem statement? WACC is the discount rate being used for all investment projects. We know it's the problem. So I take that problem statement and I build based on that problem statement and give a solution. I can't give the solution and then say this is the problem. When you go to the doctor, what do you say? Doctor, my hand is pain. That's a problem statement. Then he'll ask, based on that, he'll ask you questions and he gives you a solution. He doesn't give you the solution first and then ask, By the way, what's the problem? Does it work that way? So when you're answering the question also, try to figure out where the problem is, pick the problem out, and then start writing your answer. Understood? Am I clear? Might be different to what your lecturer has told. I can't say the name too many times because being recorded. Okay? He's a nice student of mine, very good student. Okay, let's write an answer. I'm going to give you an answer. You don't want to write? All of you are like this, take me. Right? Type, okay? You have to type how many minutes, how many words per minute should you type? Gentle speed versus speed. Can you say around 60 words a minute? Not enough. I was thinking somewhere around 180, 200. Too fast, no? Okay. Let's write. So we can say HEBAC company currently uses its WACC as the discount rate in appraising all projects. Also, I say the WACC should be used when the project's business risk and financial risk business risk and financial risk remain constant, or rather they say business risk is the same as the existing business operation. In the case of HEBAC, the business risk has changed. And therefore, project specific discount rate. Within brackets, you can say risk adjusted discount. Within brackets, you can say risk adjusted discount. Should be used. Then what's the last thing? I just got a little distracted.
Discount page is
Okay, then you can say next line rather. In calculating a project specific discount rate. It is important to identify. A similar business. Don't say similar business. Say a proxy company. Having a similar business risk. Of the new project. new project. Full stop. Then you can say the beta of this proxy company. The beta of this proxy company will then have to be matched against feedback companies gearing structure. To then give a project specific equity beta. Should or could be used. I'm not sure, but I don't know what you're referring to. Use the right verb. Okay, then you can say once equity beta is derived. It can then be applied into the PPIM formula. To derive a project specific cost of equity. Full stop and then say the project specific cost of equity can then be included to compute a project specific WACC. Which can then be used to appraise the new project. Right? I think that should be sufficient by 8 marks. Let's read and see, and if it doesn't make any sense or if there's anything that should be changed, discuss and move forward. Okay, let's move to the next question. Again, we'll have to discuss and then move on. So let's go to question 31. Okay, so we took 1 hour to work out question 31. Too much time. I think we should be able to do it faster. Okay, let's see. Anyways, the exam I think will take around 10 minutes to do the NPV computation, 10 minutes to think and write the answer. In 20-30 minutes, we should be able to finish the question. Don't worry. Okay, next company has credit sales of 45 million per year. Okay, credit sales, and on average settles accounts with trade payables after 60 days. So this is credit sales, and here they're talking about trade payables. Two different aspects. Sales generally has trade receivables. Here they're talking about trade payables. So keep that in mind. One of its suppliers has offered the company an early settlement discount of 0.5% payment within 30 days. Administration cost will be increased by 500 per year if the early settlement discount is taken. The suit company buys components worth 1.5 million per year from this supplier. Total purchase. From a different supplier, the suit company purchases 2.4 million per year of component K, 5 per component. Consumption of component K can be assumed to be at a constant rate throughout the year. The company orders components at the start of each month in order to meet demand, and the cost of placing each order is 248. The holding cost is 1.06 per unit per year. Finance director of an issued company is concerned that approximately 1% of credit sales turns into irrecoverable debt, which is bad debt. In addition, she has been advised that customers of the company take average 65 days to settle accounts, even though they require settlement within 40 days. Very simple. Nesud company finances working capital from an overdraft costing 4% per year. Assume there are only 360 days in the year. Very important. Evaluate whether Nesud company should accept the early settlement discount offered by its supplier. Evaluate whether Nesud company should adapt an economic order quantity approach to ordering component K. Critically discuss how Nesud company could improve the management of its trade receivables. As you can see here, 10 marks given for section C question or part C question, which makes life easy also. Okay. Right, so I'll give you a head start. Start with part A and B, and then we'll discuss and do the workings. Think. Hmm?
When we schedule early, we should when you schedule the credit early, we should consider that finance expense.
Shall we start? You want more time? Right. So let me move to Excel. We can say question 31. So part A is asking us to calculate whether we should accept the early settlement discount offered by the supplier. So I don't know how you all would generally do it, but what I told my students was to always look at where you are now to where you would be in the future after accepting the discount, right? So, but we would generally do is look at where your current position is, right? So you can say current position to a revised position. So what is your current trade payables? So your current trade payables, they weren't given to us directly, but we can obviously find out. So what they're saying is we are having 1.5 million in terms of total sales, and they are taking generally 60 days to repay us, or we are taking 60 days to repay the suppliers. So divided by 360. So you have a current payable days or total payable value of 250,000. And to this you can calculate your trade payable days. How do you calculate your trade payable days? In this case, it's already calculated. We are at 60, so don't worry about that. Then you can calculate finance cost. Okay. So finance cost in this case is 250,000 into your percentage. Your percentage is 4%. So you are at 10,000 in terms of finance benefit ideally. Okay. I would rather say finance cost saving. Now, what is happening after that? You're going to revise your trade payables now, but they're saying is you're going to pay earlier, which means you're going to 30 days. Going to 30 days. So when you go to 30 days, what will happen to trade payables? It should ideally fall. So you multiply by 30 instead of 60. Again, 125,000. Apply the same formula. So what is technically happening? Your finance cost saving is reducing by 5,000. In other words, finance cost will increase by 5,000. Finance cost will increase by 5,000. In addition to that, do we have anything else? We have an administrative cost, right? Administrative cost increase. That will increase by how much? $500 per year. You can say $500 per year. So take the summation of these two. So total cost to you will be 5,500. But don't forget, you need to work out the benefit also. So what is the benefit of this? Benefit is you will pay less cash. So how much of less cash are you going to pay? So the discount the people are offering is 0.5%, 0.5% discount. So what you can do is you can calculate discount. So this would be 0.5% into your total sales. That will give you 7,500. So therefore, net benefit, the difference between these two, 2,000. So you have a net benefit, so it's a positive value. What you can do is you can expect to accept the early settlement discount. So you can write that down as well. Since the benefit is greater than cost, accept the early settlement discount. So if you can do this working, you'll get. Have you done part B? Okay, finish part B and then we'll discuss. We calculate the finance cost. No, not on your question, but you will always calculate your discount not on payables, but on your total sale. Your total sale. Because payables is the balance at a given point in time, as opposed to sales, which is the total or the purchases, the total purchases you make during the year. Don't consider discount as much. Work it on the gross value. Okay. So let's look at the next part of the question, which is asking on the inventory model. Evaluate whether an effort should adapt an EOQ as opposed to their current ordering policy. So what it's best to do is to then obviously find out what is your current ordering policy, and then based on that compare against EOQ. So let's work this out. What you can do is you can say current ordering policy. So work out the total cost under this ordering policy. The total ordering cost. So in this case, you are making how many orders? What they're saying is you're going to order a constant. The company orders components start of each month. So 12 orders are being made. 12 orders are being made into the cost per order. What is the cost per order? In this case, your cost per order is 248.44. So your total ordering cost will be 12 into 248.44. Then your total holding cost. So in this case, your total holding cost is 1.06 per unit per year. You need to also understand how many units you're going to hold. So it will be average inventory. So maybe do a small working to calculate your monthly demand. So annual demand is $2.4 million. Yeah, $2.4 million divided by 5 per component, so that's 480,000. Therefore, monthly demand will be this divided by 12, 40,000. So in this case, what you can do is you can take 40,000 divided by 2. Why divide by 2? Because that's your average inventory per month. Multiplied by 1.06. The cost of holding 1 unit for 1 year. So take 20,000 into 1.06 and add up these two. End up with 24,180. That should ideally be your current ordering policy total cost. Then you can work out an EOQ model. So first find out your EOQ, which is equals to square root 2 into C naught, which is your ordering cost 248.44 into your annual demand is 480,000 divided by 1.06. You can work that out here. Right, to get 15,000 units per order, right? Right. Then you can do the total ordering cost and holding cost once again. So in this case, your total ordering cost will be 12. Will change now. We'll have to look at how much you're ordering per time. So it will take D over Q. So 480,000 divided by 15,000. That's the number of times you'll order, right? So do the same thing here. 480,000 divided by 15,000 into 248.44. So you get 7,950. Then your total holding cost will be Q over 2. So in this case, that becomes 15,000 divided by 2. So get 15,000. So based on this, you can look at the current ordering policy versus the EOQ model, then compare your answers. So net benefit in moving to EOQ is 8,280. And you can also write a sentence to say if they move into EOQ, you will save 8,000 of it. Just write a sentence. I want a break. The stamina, man. Stamina. Okay, we'll do this part and head for a 10 minutes. I generally only give 10 minutes. Asija gives more. I give 10, generally 15 minutes. You don't need a break, man, every 4 hours. Ideally, you can go 4 hours straight without a break. Not constantly working. I'm doing all the hard work. These people sleep also. I don't wake them up. Correct. Okay. 10 marks done, 10 marks to go. Critically discuss how Nisud company could improve the management of its trade receivable. Now here the problem is 1% of credit sales is turning into recoverable days. They are taking 65 days to settle when they're supposed to settle within 40 days. Big problems there. Address those problems. So I don't know whether your lecturer has given you those points. That there are around 4 or 5 that you can always talk about when it comes to management of trade receivables. First one is not factoring. That's an external mechanism you can use. One is credit analysis. First, do the analysis to see whether the customer is credit worthy. Then you do credit control. That's your invoicing, right? Or you can look at invoicing, let's say, collection of receivables, right? If nothing is happening, then you send them reminder letters, right? So these are things that you can do, right? So we'll write down an answer. Last, you can say factoring
About stocking service.
on the credit card. Yeah. So we'll write down. You can say Nesud company can look to improve. Yeah. Sorry, I was saying Nesud company can look to improve its management of trade receivable. Through credit analysis, prompt invoicing, credit control, or even through external resources, such as factoring. Next time you can say, prior to offering credit to customer, it is important to carry out a credit analysis. To minimize the risk of default. Okay, and you can say this can be done through bank references, references from credit agencies, annual reports, or records of previous transactions. Next line you can say, once a sale is made, it is important to invoice promptly to ensure to ensure is complete to ensure no delays, or let's not say delays, no free credit, no free credit is provided to customers. So stop and say regular statements need to be issued. Regular statements need to be issued to customers prior to amounts becoming overdue. Prior to amounts becoming overdue. Amounts becoming overdue. Full stop and you can say a cash discount, a cash discount for early settlement should be evaluated. Cash discount for early settlement should be evaluated. Okay. Any delays in collection or any delays in payments, any delays in payments from customers should be dealt methodically, should be dealt methodically with reminders being sent out, with reminders being sent out, comma, contacting the customers, contacting the customers, and finally use legal action. Finally take legal action. If there is no progress. Okay. Then you can say next line. Any customers offered credit should be monitored regularly. Monitored regularly. To ensure they do not surpass. To ensure they do not surpass their credit limit. Their credit limit of their due dates or the due dates. Next line you can say. The company could also resort to using factoring. Using factoring. Which could help recover cash from customers. Full stop and say. It's important to understand, or rather say it is important to evaluate the cost and benefits of it. The cost and benefits of it. Before proceeding with the factoring agent, before proceeding with Factoring agent. Okay. And that's sufficient for 10 marks. Okay. Read through and see. It makes sense. Okay. You want a break? I go back in 10. So now we'll quickly move into section B. Now section B also you will have to use the same methodology to select which question you want to do. Okay, the first one again is talking about first one, what is it talking about? It's talking about some foreign exchange scenario. Interesting, easy, not too difficult. Phone is dead. So we'll put it on screen. Okay. So question 16 to 20 is on forex. So we can say here forex. So you can rate your liking to do the question. Then this is on valuations. So this is valuations. So business valuation. And then the last one is again on investment appraisal. Okay, now which one do you want to do first? Investment appraisal? What do I like? Right now, if you ask me what I like to do, I like to go home now. Yeah. Okay. So we'll take 5 minutes. Enough? Yeah, this question. So it says the following information relates to an investment project which is being evaluated by the directors of Fence Company, a listed company. Initial investment payable at the start of the first year of operations is 3.9 million. Scrap or net operating flows are given 1.2, 1.5, 1.6, 1.58. Scrap value is given as 100. The directors believe that this investment project will increase shareholders' wealth if it achieves an ROCE greater than 15%. As a matter of policy, the directors require all investment projects to be evaluated using both payback and ROCE methods. Shareholders have recently criticized the directors for using these investment appraisal methods, claiming Fence ought to be using the academically preferred NPV method. The directors have a remuneration package which includes a financial reward for achieving an annual return on capital employed greater than 15%. The remuneration package does not include a share option scheme. What is the payback period of the investment project? Okay, quickly work it out. Payback investment. We'll work question by question and go. Once you get 26 correct, we'll mark it and go. So in this case, payback. So this is, I think, simple payback, no discounted payback. So you say 3.9 plus 1.2 plus 1.5, that is 2.7 plus 1.6. At this point, you will pay back, right? So what is the difference between these two? 1.2, 1.5, 2.7, 3.9, 1.7, correct? 2.7 minus 3.9, 0.8.
2.7.
2.7. Yeah. So, sorry, I was trying to get this one. Plus 1.2 plus 1. Minus 1. So you have 1 point minus 1.2. What you can do is take 1.2 divided by 1.6. This you said was 0.75. So this is 2 plus the amount of years. Yeah. So 2.75. Okay. Can you increase the ACH? Hold for come front. Why? Allergic. No, don't. It's straight. Put 24 is okay. What's the 18? Based on the average investment method, what is the ROCE of the investment project? So what you can do is take the total operating cash flows. What is the total operating cash flows? So 1.2, 1.5, 1.6, 1.58. Total operating cash flows would be 2000. You can deduct depreciation after considering the total cash flow. So if you take the total cash flows, I think you get 5.8, 5880, no? So you get 5,880. Then you can deduct your total depreciation. So how do you get total depreciation? Total depreciation is always calculated as investment minus scrap. So this is 3.8. So you're left with then 1.92. 5,880 minus 3,800, 2,080. So you're left with 2,080. So this 2,080, you will have to take it as your profit for the whole year. Divide by 4 will give you the average profit per year, 520. So average profit is 520 divided by average investment. So what is your average investment? So that will be 3.9 plus 100 divided by 2. So 520 divided by really 2000. So you should get 26% average investment. So 3.9 is the total investment plus scrap divided by 2 is the average investment. So here we are talking about average profit divided by average investment. Yeah. Okay.
But they can from it to like total investment.
Average profit over initial investment. Okay. 28. Which of the following statements about investment appraisal methods is correct? The ROCE method considers time value of money. Wrong. ROCE must be greater than cost of equity if a project is to be accepted. Correct. ROCE has to be greater than what? Company is required, right? Not cost of equity. Riskier projects should be evaluated with longer payback periods. No. When you have more risk projects, your payback has to be shorter. You will be able to recover the cash fast. So therefore, through elimination, the last one is the correct answer. Okay. 29. Which of the following statements about Penn's company are correct? Managerial reward schemes of listed companies should encourage the achievement of stakeholder objectives. Ideally correct. Requiring investment projects to be evaluated with return on capital employed is an example of dysfunctional behavior encouraged by performance related pay. Ideally, because ROC is based on profit. Penn's company has an agency problem as the directors are not acting to maximize the wealth of shareholders. Why? Why is that correct? Fence company has an agency problem as the directors are not acting to maximize the wealth of shareholders.
That issue is managed. Wait.
I didn't get you.
Like the gap between directors and shareholders is it agency? Or is it managers and shareholders?
It can be directors and shareholders, or managers and directors. So here, no, why are they saying that they are not acting to maximize the wealth of shareholders? They are saying has an agency problem. First, you have to identify from the fence company question, do they have an agency problem? So based on the question, do they have an agency problem? No, why? Why?
The remuneration package also include financial reward.
They have a problem.
They have a problem, no? Why? They say the remuneration package does not include a share option scheme. What does that mean? If they don't have a share option scheme, they don't think like shareholders because they are not shareholders of the company. What you are saying is correct. They are getting a remuneration package linked to the financial reward, blah blah blah. So short term, if I know okay, I'm going to leave the company in another 2 years. For these 2 years, I'll try to maximize the amount of earnings I get from the company. But the company says, okay, you have projects that are having ROC more than 15%, no problem, take it in. Then I get evaluated based on that, I get a bloody big bonus. 2 years later, I leave, I don't care what happens to the company. But the moment you give a share option scheme, you lock the bucket. So now, in this case, ideally this is correct, this is correct. Now there is an agency problem, therefore this is correct. Okay. Right, one more question. No? Which of the following statements about Fence company directors remuneration package is so are correct? Directors remuneration should be determined by senior executive directors. Is it correct? Who should determine directors remuneration? Who should determine directors remuneration? Shareholder. I can't say wrong, but I can't say correct also. Something called treasury remuneration committee. Remuneration committee. They will determine the salaries. Okay, so first one is wrong, which means this is out, this is out. So don't have to read the second one because it's anyways correct. Go to the third one. Linking financial rewards to a target return on capital employed will encourage short-term profitability and discourage capital investment. That's exactly what I said now. Simple. Too simple. How many minutes did you spend? 6 minutes to answer 5 questions. You can't fail this paper, man. You want me to come with the exam and do the answer with this? Lovely. So we got results for the University of London students on Thursday. Fantastic. Fantastic. I had a class of 26. Batch of 26 students is Saturday. That financial management compared with this is nothing. This is peanuts. That is crazy difficult. Crazy difficult. Huh? Right? No. This financial management is easy. That financial management is very tough. Your option pricing and all of that. No. This is the University of London, not the degree they plan to give here. This is a different degree. Right? Standard is very high. Pass mark is 40. Out of 40, and if you get 70, you get a distinction. So out of the class, out of 26, 12 got distinctions. One student got 98, 2 students got 94. 94. So I hope The student who got 98 will get a world prize. They send the email in like few weeks. Then out of the 26, one got absent. Only one student failed. So pass rate was 98%, 97%. Right. So just trust the process. Listen to what I say. Do as I say, you will pass. Okay, irrelevant. This question, we'll do this now, no? Or you want to do business valuation first? Sorry, forex first. You all have to decide. You all tell me. I'm not with anything. Business valuations. Okay, we'll do the valuations first. So this uncle has been around since when I was doing ACCA. So in 2012, when I was studying ACCA, he was not in this institute, obviously, different place. Nice guy. Okay, question number 21. The following questions relate to, or scenario relates to questions 21 to 25. Ring company has in issue ordinary shares with a nominal value of 0.25. These shares are traded on an efficient capital market. It's now 2026 and the company has just paid a dividend of 0.45 per share. Recent dividends of the company are as follows. Ring company has also an issue loan notes which are redeemable in 7 years time at the nominal value of 100 per loan note, which pay interest at 6%. The finance director of Ring company wishes to determine the value of the company. Ring company has the cost of equity of 10% per year, before tax cost of debt of 4% per year. Company pays corp tax at 25% per year. So if you look at any business valuation question, what is the foundation or the premise that we use? Yes, madam. What is the premise that we use? What is the foundation to any valuation that we do?
Their methods.
Huh? Tell me. I can't hear you properly. I'm very bad at lip reading. Tell me. But say it's okay to be wrong. It's better to be wrong today than be wrong in the exam. But tell me, don't be afraid, man. Tell me. Always refer to this equation which says market value of any investment is equals to present value of returns discounted at investors required rate of. This is the premise. Any valuation, whether it's shares, whether it's debt, convertibles, anything, stick to the same equation. The same equation is what you will use for cost of capital also. This is the foundation. This is the premise of any valuation. That market value of investments are equal to present value of its returns. I told these buggers, when you go home, right, take a piece of paper, write this equation, paste it on your bed or somewhere on your wall. Before you sleep 3 times a day, you read this. Before you, after you get up, first thing you do, read this 3 times. Then by the end of the session, you will memorize. And you ask him whether he did it. No, he didn't. Right? Irrelevant. Okay, now quickly calculate question number 21 to 25. I'll give you 10 minutes, quickly do it. This, if I'm doing the answer, you are just copying down. That's what I noticed in the previous one. No, all up to 25.
Redemption in file.
Yeah, because they say at the nominal value.
We use 12% or should we get the post tax?
Where is 12%? No, you can't use cost of equity for debt.
We have to get the post tax.
Cost of debt.
We should take as 6, so we should deduct KD1 minus. Because we are paying for the company.
You are?
We should take the interest and deduct.
That's that now. See, when you look at this equation, what does it tell you? Market value of investment is equals to present value of returns discounted at investors required rate of return. When you're calculating the market value. So when you're calculating market value, if you're going to use investors required rate of return, we don't use KD1 minus T, we have to use KD, which is pre-tax cost of debt. Pre-tax cost of debt. So if you're using pre-tax cost of debt, your interest also has to be calculated pre-tax, which means interest, not interest 1 minus T. But if you are calculating WACC, then you will use post-tax cost of debt. Then you have to use interest also post-tax cost. Post-interest. So valuations pre-tax. Pre-tax is given, no? They haven't said pre-tax, but they've said before tax. Install.
22nd.
Okay. Once again, so we are referring to this equation. Market value of investment is the present value of returns discounted at investors' required rate of return. Now, when you take a loan note, it can be either redeemable or irredeemable. In this case, they are saying it is redeemable. So when you take a redeemable loan note, what are the returns you will get? You will get interest as a return, and you will get redemption as a return. Interest will be annual till maturity. Correct? This redemption will be at maturity. So if you rewrite this equation for redeemable debt, that would be market value of redeemable debt is equals to the present value of interest payments plus present value of redemption. Those are the two returns you get. The present value of interest payment will be your coupon rate into your nominal value. This will give you the interest value multiplied by, since this will be an annual payment, annuity factor, and then redemption will be, in this case, nominal value. Since it's a one-time payment, you can multiply by a discount factor.
You use the annuity factor 4%, right?
So in this case, since they say before tax cost of debt, it's important. When you're doing valuations, you will always consider pre-tax, before tax. So your before tax cost of debt is being given as 4%. So for my annuity factor, here I have used, as you can see, if it's not maybe clear, I'll write again. By using annuity factor at 4% for 7 years. Why 7 years? Because your redemption is happening in 7 years. So from year 1 to year 7, interest has to be paid. At the end of year 7, you get a redemption.
Yeah, so the problem is that I use 9%. I use the post-tax.
So post-tax will be less than 4%.
Exactly. That's
No. You said you use 9%. How do you get 9%?
sorry. It's supposed to be 10 into 1 minus 1.
Right.
So where would be post-tax cost?
Yeah, so exactly what I was telling him before. When you're doing a valuation, use pre-tax, because we say here, based on this equation, investors required rate of return. Investors required rate of return when you're doing a valuation. The post-tax is from the company's perspective. Therefore, use for WACC. So WACC, you will use post-tax. Pre-tax when it comes to valuations. Okay. Look at the next three quickly. So ask questions. Don't feel afraid. Don't feel shy. Even if you ask me, so what is my name? I will tell you. That also can be a valid question in case you forgot. You will only learn if you ask questions. Otherwise, you will not learn. Question number 23. I think my 4-year-old kid also knows the answer. Question number 23. My 4-year-old kid also knows the answer, I think. C. Yeah, because net asset value. What is net asset value equal to? This balance sheet equation, grade 8 student will know. Is equal to equity. Right? So which means total assets minus total liabilities. So there is total assets, non-current assets plus current assets is total assets. Less total liabilities. Simple. So got that wrong. Ideally what you should don't do, but ideally what you should do is close the laptop, get up, go back to grade 1. Start again school. Then some school will accept you in grade 1 also. Then from grade 1 you will start learning, you will become first every day in class. Your parents will be proud of you. Then when you come to A levels, then you come to ACCA and meet me. 14 years later. Okay. You got this. Okay. Which of the following statements about valuation methods is true? So I'll tell you a trick. Don't do this always. Huh? Don't do this always. There can be questions where you don't know which is the correct answer. No? There can be questions. Okay. When there is a question, let's assume this question, you have 24 seconds more to go. No time to read the question, understand which one is correct. Last question of the paper. Assumption, I'm putting a scenario in your mind. If I give you 2 seconds to select which is the right answer, which one will you select? Ideally, you will select the longest one. Why? Examiner will never write a wrong answer too long. Keep it short. So in this case, I'm just going to put a dot here. Okay. We'll try and see if it works. Huh? I'm going to put a dot here. And also, okay, this is the longest answer, so I'm going with this answer. Generally, if you run out of time, if you get a question like this, or if you're stuck, you don't know what to do, it won't always work. Most often it will work. Select the longest answer. Why? Examiner will never take the effort to describe something wrong in a long sentence. You won't do that. Something that's wrong, they'll keep it short. Can't be bothered writing something long for it to be wrong. No? Don't tell this to other people. Don't tell this to other people.
That's the correct answer.
I don't know. I have to read. Okay. The earnings yield method multiplies earnings by earnings yield. Is that correct? No? What is earnings yield? What is the formula for earnings yield? Earnings yield is the reverse of P ratio. So P ratio is MPS over EPS. This is EPS over MPS. Okay. So if you want to calculate your valuation through earnings yield, what do you do? Ideally divide, or you can take one. So this is wrong. Equity market value is number of shares multiplied by share price plus the market value of debt. Wrong. As soon as you say debt, it can't be equity market value. Wrong. The dividend valuation model makes the unreasonable assumption that average dividend growth is constant. That is correct. So which means theory has worked in this case. Huh? You can apply it in another same scenario and see. Okay, ideal scenario would have been to apply it into question number 25. Right. Which of the following statements about capital market efficiency is or are correct? Inside information cannot be used to make abnormal gains in a strong form efficient capital market. You say correct, others? Just thinking, capital market. This is efficient market hypothesis. Ideally, it has to be correct because when you have a strong form efficient market, what you are saying is even insider information won't allow you to make profits. Right? All inside information is reflected in the shares already. It's not a real world scenario. Real world stock sits in a strong form. So this is correct. In a weak form efficient capital market, ring company's share price reacts to new information the day after it is announced. Incorrect. Why? Because weak form is always about past information only. Past information only. Ring company's share price reacts quickly and accurately to new released information in a semi-strong form. That's the whole definition of semi-strong form. Very simple questions. Huh? These are exam questions. Huh? Mock papers. I'm not handpicking some questions and putting it into a mock. I don't have the time to do all of that. Ready-made mock, I download and I come and give you. Very simple. Okay, let's do the last third question quickly. Forex. So by now you should have secured how many marks? 50 marks now already. 40, 40, and then 50 marks secured, you pass. Now you can close the paper and go home if you want. Under the condition that you know everything is correct. Or if you are ambitious, you can aim for a world prize. Why? Not difficult, man. I had one student of mine who got a world prize for finance. He got 89, I think, or 92. One of those, I can't remember the exact score. This is 2018 world prize. That same year, I think Aziza got world prize for advanced financial. Scored 96 or something. Okay, quickly do. Easy questions, huh? Third company is based in a country whose currency is the dollar. Company expects to receive 1.5 million in 6 months' time from Find company, foreign customer. The finance director of her company is concerned that the euro may depreciate against the dollar before the foreign customer makes payment, and she is looking at hedging that receipt. Her company has in issue loan notes with a total nominal value of 4 million, which can be redeemed in 10 years' time. The interest paid on the loan notes is at a variable rate linked to LIBOR. Now we don't have LIBOR, this paper is a bit older, so LIBOR they've used, but generally now they would use SOFR, secured overnight financing rate, okay, instead of LIBOR. Same thing. Finance director of her company believes that interest rate may increase in the near future. Spot exchange rate is 1.543. Domestic short-term interest rate is 2%. Short-term interest rate is 5% per year. Okay, quickly do it. I'll give you 10 minutes. Finished all. Finished all. Do all. So do. Okay, so they're asking 6 month forward rate predicted by the interest rate parity theory. So what does the interest rate parity theory tell us? Interest rate parity theory tells us your forward rate is equals to your current spot rate into 1 plus IC divided by 1 plus IB. This equation is given to you in your exam. So S0 is your current spot rate. Current spot rate is 1.543 per dollar into 1 plus IC. IC is the interest rate of the counter currency. What is the counter currency here? Euros. So euros is 5% and dollars are 2%. So how much do you get here? 1.566. Okay. As regards the euro receipt, what is the primary nature of the risk faced by herd company? Primary nature of the risk faced by herd company. Yeah, it looks like a transaction risk, no? One-time payment. They are not talking about continuous payments. Right. So I would say transaction risk. Consider it as transaction risk. Which of the following hedging methods will not be suitable for hedging the euro receipt? Ideally, currency swap. Okay, currency swap. Which of the following statements support the finance director's belief that the euro will depreciate against the dollar? So for the euro to depreciate against the dollar, meaning you will need less dollars to buy euros now, right? So which of these statements will be correct then? The dollar inflation rate is greater. The dollar inflation rate is greater. Dollar will depreciate. So therefore, this does not support. The dollar nominal interest rate is less than euro nominal interest rate. What is nominal interest rate? It is interest rate after inflation is factored. So if you have a lesser nominal interest rate, it means you have a lesser inflation. If you have lesser inflation, currency appreciation, therefore supports the index. Okay. Right. The last one, which one is correct? Ideally, first one is correct. They're saying in exchange for a premium, herd company could hedge its interest rate risk by buying interest rate options. Yeah, you can do that. Buying a flow will give herd company a hedge against interest rate increases. In this case, are they borrowing or lending? Borrowing, no? So yeah, it won't. You will put a cap on. Herd company can hedge its interest rate risk by buying interest rate futures now in order to sell them at a future date. Wrong, it's the other way. They have to start selling interest rate futures today. Take out a variable rate overdraft will allow herd company to hedge the interest rate risk through matching. Okay, so that's the first section B question. Okay, let's quickly work out the rest quickly. I'll give you 10 minutes also. See if you can quickly work out. We'll finish the paper before today. You go. Are you tired already? Tired? What work did you do then? I already did all the work. Thinking. You're tired of thinking. Finished, mister. Don't sleep, man. Huh? No, no, do all 50. We have time till 12:05. Huh?
It's very easy.
Very easy. Then do quickly. Finished. Any question that we don't discuss today, we can pick up. I think the first question was straightforward. They're asking you minimum price per share which the owner should accept for the company. So if you look at your net asset valuation, like what we discussed before, taking total assets minus total liabilities, that comes to 28 million. So this is 28 million. So you divide that by the number of shares, which is 2 million shares, then you should get $14 per share, right? So ideally it has to be $14 that you consider as your minimum price per share. Which of the following instruments will not be traded on a money market? So money market, commercial papers will be traded, convertible loan notes will not be traded, treasury bills will be traded, certificates of deposits also can be traded. Which of the following areas of financial management will the impact of working capital be smallest? Liquidity management, you need it. Interest rate management, yes. Why not? Because the interest rate also is impacted, no? Working capital will impact interest also. How much of interest you pay out? Let's say you increase your payables or decrease your payables, receivables, so on and so forth. Management of relationship with the bank, that's also there. Ideally, dividend policies won't impact working capital management. You okay, madam? Which two of the following are descriptions of basis? Which two of the following are descriptions of basis risk? It is a difference. So first understand what is basis risk. The deviation between your spot rate versus your futures rate. Okay. It's a difference between spot exchange rate. It's not exchange rate, it's on interest rates. So the first one is wrong. It is the possibility that movements in the currency futures prices and spot prices, sorry, when I said in this case, you are consider not your spot rate, spot exchange rate, but spot price. Huh? So that's why it's wrong here. This is wrong. It's possibility of that the movements in the currency futures price and spot price will be different. That is what is basic. That's the definition of basis risk. So this is correct. It is the difference between fixed and floating interest rates. No. So therefore, the fourth one has to be correct. It is one of the reasons of an imperfect currency futures hedge. Okay. 4. Which of the following is not a description of basis risk? It is a difference between spot rate versus your futures rate. It is the difference between spot exchange rate, but spot price. So this is correct. It is one of the reasons of an imperfect currency futures hedge. fifth one, I worked it out. They're asking in relation to finished goods inventory and assuming a 360-day year, how much finance will be needed from the overdraft. So what you need to understand is they're saying great company has sales of 200 million per year and the gross profit margin. So when you say gross profit margin is 40%, cost of sales has to be the balance 60%. Finished goods inventory days vary throughout the year within the following range. So maximum 120, minimum 90. Minimum would mean there's always 90. That's what minimum means. Huh? Then it says all purchases and sales are made on cash basis and no inventory of raw materials or work in progress is carried. Craig intends to finance permanent current assets with equity and fluctuating current assets with its overdraft. So what you're trying to fund here is the fluctuating current assets. What is the fluctuating current assets? So when you have minimum 90 days, this becomes part of your permanent current assets. It's always in the business. Permanent current. This difference between 120 and 90 is what fluctuates. It can be 90 today, tomorrow 120, come down, go up, so on and so forth. But it will never go below 90. It will never go below 90. So these 30 days of fluctuation is what you are trying to manage through an overdraft. So quickly compute a 30-day inventory value. So your total in cost of sales is 120 million. That is 200 million into 60%, 120 million. So that you calculate 30 days, you get a balance of 10 million. Right. Okay. Just Kashif. You're like in a horror movie, covering your eyes and anything, not looking at what the answer. Okay, understood. Okay. In relation to in irredeemable security paying a fixed rate of interest. Irredeemable security or irredeemable debt. Which of the following statements is correct? As risk rises, the market value of security will fall to ensure that investors receive an increased yield. Irredeemable security paying fixed rate of interest. So, since they're talking about market value of irredeemable debt, what you can say is market value of debt is equals to interest divided by KD, correct? That's your this one, right? So what they're saying is that the risk increases, cost of debt should increase. So which means this will increase. When cost of debt increases, market value of debt will fall. Correct, no? Mathematically correct. When the denominator increases, total value will fall. I think this is correct. POP company is switching from using mainly long-term fixed rate finance to fund its working capital to using mainly short-term variable rate finance. Which of the following statements about the change in POP's working capital policy is true? Finance cost will increase. When you move to short-term variable rate, it should reduce. Refinancing risk will increase. What is refinancing risk? I won't say switching, but when you move into short-term, no sooner the overdraft has to be paid, you have to pay it back. Then generating a new source of finance again can be a problem, right? So that should ideally be the answer, but let's read through the rest. Interest rates will decrease. Ideally short-term rates are higher, but total cost will be low because you paid only for a small period of time. Overcapitalization risk will decrease. Can't say. That depends on your strategy. Okay, which of the following is not an advantage of withholding a dividend as a source of finance? Which of the following is not an advantage? Retained profits are a free source of finance. Investment plans need less justification. Issue costs are low. It is quick. Not an advantage of withholding a dividend. The following is not an advantage. Not an advantage. So it's a disadvantage. Investment plans need less justification. Issue costs are lower. It is quick. Those two are advantages. So when you have So when you withhold the dividend, it's basically retained profits. Think of it that way. When you retain profits, no issue costs, you can use it. It is quicker because you already have it with you. Investment plans need less justification. What does that mean? Investment plans need less justification. Investment plans need less justification. Maybe if you look at it from this perspective, when you want to borrow from a bank, you'll have to give a proposal as to why you need a loan. If you're going to get equity, you will need to give a prospectus. If they are meaning it that way, then yes, here you don't have to do justification. You just say, okay, I have an investment proposal to do. I'm going to do this cash. So ideally, these two are definitely correct. This looks like it's correct, which means this is your final answer. Retained profits are a free source of finance. Yes. Sorry.
Isn't that like net?
Saying free source is the problem. You can say it's no issue cost, correct? But it comes at opportunity cost. Can you say free is the question? Because somebody requires a return. It's not free. Somebody is asking for a return, which is your equity holder. So you'll have to give them a return. So it's not free technically. So therefore, I think that has to be. No, company only has to pay the return. Then why do you have something called cost of equity? You have a cost of equity because you need to give back someone you've taken money from. Okay. Right. Question number 9. A company has annual after-tax operating cash flows of 2 million per year, which are expected to continue in perpetuity. The company has a cost of equity of 10%. Before tax cost of debt of 5%, after tax weighted average cost of capital of 8% per year, corp tax is 20%. What is the theoretical value of the company? So again, you can stick back to that equation, market value of investment is equals to present value of returns. When you look at a company, market value for company is present value of cash flows. So what is your cash flow here? 2 million cash flows after tax. Then you are funded through equity and debt. Therefore, you can use your cost of capital itself straight away. So straight away, present value is equals to cash flow divided by R. So in this case, I have taken 2 million divided by my WACC of 0.08. So you get 25 million. Okay, which of the following would you expect to be the responsibility of the financial manager? Providing annual accounts, no. Producing monthly management accounts, advising on, yeah. Easy question. Okay. Lend company has in issue 3% convertible loan note. So 3% is your coupon rate. Redeemable in 5 years time at their nominal value of 100. Alternatively, each loan can be converted in 5 years time into 25 shares. The current share price is 3.6 and future share price growth is expected to be 5%. The before tax cost of debt of this loan notes is 10%, corp tax is 30%. What is the current market value? So I've done the exact working here. So market value again is present value of returns. So in this case, what is your returns? You're going to get interest for 5 years and you're going to do a conversion. So I've done the conversion value here. You get 25 shares at 3.6 each. Your share price is going to grow by 5% for 5 years. So you end up with 114.87. So you're going to discount at 10% because the cost of debt is 10%. So then you take it at, you already did this question, no? Did got the answer? Mister, did? Why? Don't, not do, okay? 82.71 has to be your answer. Did you work it out, sir? Just now woke up. Madam, you okay? Got it? Okay, good. Country X uses the dollar as its currency and the country Y uses the dinar. Country X's expected inflation rate is 5% per year compared to 2% per year in country Y. Country Y's nominal interest is 4% per year and the current spot exchange rate between the two countries is 1.5 per dinar. Okay, according to the four-way equivalence model, which of the following statements is or are true? Country X's nominal interest rate should be 7.06 per year. I couldn't work this out, but we'll work it now. Currency X's nominal interest rate should be 7.06 per year. Is that correct? Didn't know how to do this.
I forgot that.
Okay, so four-way equivalence model will have your PPPT. It says 1 plus HC or 1 plus HB is then equal to put it here is equals to S1 over S0. On this side you have IRPT, which is 1 plus IC or 1 plus IB is equivalent to F0 over S. This is your four-way equivalence model. Now, what information have you been given? You have been given, so if you rewrite this here, expected inflation rate of country X is given. So, your base currency is dollars. So, X is dollar, X is the base currency. So, your inflation rate of X is given. So, we'll write it here 1 plus 0.05 and other country is 2, right? This is equals to then 1 plus IC is the country wise interest rate 0.04 divided by what you are trying to find out, 1 plus IB. So work this out. So when you work this out, what do you get? 1 plus IB is equals to 1 plus 0.04 divided by 1 plus 0.02 into 1 plus 0.05. Okay, correct. So take 1.04 into 1.05 divided by 1.02. That's all. How much do you get? Do. Lazy buggers.
I got 6%.
It's 6%. How much do you get? I can work it out. 1.04 into 1.05 divided by 1.02. You get exactly 7.06. This is true. Huh? It's 1.04 into 1.05 divided by 1.02. No, you still get it.
0. The into 1 plus 0.
In 1.05. Still don't get it.
I think my phone calculator is a bit.
Right? We work it out later and see. The future expected spot rate after 1 year should be 1.4571. So that's a simple, straightforward computation. So here what will happen is you get 1.5 into 1.02 divided by 1.05. Use your PPPT equation. So S1. So in this case, S1 would be how much? $1.02 divided by 1.05, 1.457. This is correct. Country X's real interest rate should be higher than that of country Y. No, ideally real interest rate should be equal. Has to be equal. So false. Okay, which two of the following statements or government actions would lead to an increase in aggregate demand? Increased tax, aggregate demand will come down. Decrease tax, it will increase. Increasing government expenditure, correct. Decrease money supply, demand will fall. Decrease interest rates, demand will increase. So 2 and 4. Okay, which company's return on capital employed? How much is that? Profit before interest and tax is given 2.5 million. Profit before tax, profit after tax. Return on capital employed is based on operating profit. So take 2.5 million divided by return on capital employed. What is your capital employed in this case? 10 million plus 2.5. How much is? Hmm? 20%. 20%. The last question, Drumlin Company has 5 million of 0.5 nominal value ordinary shares in issue. It recently announced a 1-for-4 rights issue at 6 per share. Its share price on the announcement of the rights issue was 8 per share. What is the theoretical value of a right per existing share? Theoretical right of an existing share. How do you find the theoretical value of a right per existing share? TERP minus issue price. Value of a right, TERP minus issue price, correct? So value of the right, first you find out TERP. What is your TERP? So you're going to go for a 1-for-4 rights issue. So you already have how many shares? Yeah, 10 million shares. So you have 5 million divided by 0.50. So you have 10 million shares now. So you go for 1-for-4 rights issue, you're taking 10 million into 1/4. That is 2.5 million additional shares. So calculate your TERP. So you already have 10 million shares, current share price is 6 into 10 million shares plus you're going to go for 2.5 million new shares. How is the right share higher than the normal? Sorry, this is 8, no? This is 8, this is 6. Divided by total number of shares, 10 million plus 2.5. So this is 8. 8 into 10, 80 plus 6. Get 7.6. 7.6. 7.6. So your TERP is 7.6. Value of the right. Value of a right is your TERP minus issue price. So what is your TERP? 7.6 minus 6. So this is 1.6. But they are asking value of a right per existing share. So per existing share, you take 1.6 multiplied by 1/4 is 0.4. This answer has to be 0. Okay. Take it up. Done and dusted. Done and dusted. I already did. We're going to do entire papers today. I just sent you the. So, like we did last week, we're going to do an entire paper today, and we'll we'll start from section C, just like we did last time, right? So like I always tell you, just quickly check to see which section C you would like to start off with, or which question under section C would you like to start off with, right? I think question number 2 or 32 for that matter is on cost of capital, and section or question number 31 is on looks like what is it, working capital, I think, working capital. So it is your choice then which one you would like to start off with. Would you want to do working capital first, or would you like to do cost of capital? Cost of capital? Okay. Working capital. Okay. So we'll start with question number 31 for that matter. Okay. So it says KC Company is a small owner-managed manufacturing company which manufactures one product. Each unit of their product requires two main input materials, F2 and H7. These materials are purchased from KC Company's two main suppliers. KC Company is currently facing cash flow difficulties. It has gradually extended its overdraft over the past 3 years to its current level of 1 million. The company also has a loan from the bank for 1.5 million, which is due for repayment in 2 years' time. So, bit of a problematic company. The loan is secured on the business premises. Okay. KC Company pays interest on its overdraft at a rate of 15%. KC Company's bank has suffered recently as a result of the banking crisis and has now tightened its lending policies. It has therefore asked KC Company to reduce the level of its overdraft by half within the next year. The finance director is understandably concerned and considers that better management of working capital could release some much needed cash. The two proposals are being considered. Proposal 1, where you have KC Company currently purchasing all of its F2 from supplier A and obtains a 1.5% discount for settling invoices within 10 days. Standard payment terms are 4 to 5 days. The FD is proposing that KC Company revert to the standard payment terms with supplier A. Total purchase from supplier A in the year are 6 million. Okay. KC Company requires 10,000 units of material H7 each month, and this is purchased from supplier B. Supplier B offers a discount of 5% on the normal purchase price of 0.5 for orders of 20,000 or above, and KC have always taken advantage of this discount by ordering 20,000 units at a time. The cost of placing an order with supplier B has been calculated as $45, and the holding cost is 1.2. FD is proposing to reduce the quantity of H7 ordered each time to the economic order quantity level to reduce the holding cost, although this would mean losing the bulk discount. Now this question has been set out in the reverse of what you would normally do. In a normal scenario, what you would do is you would look at this question and then say, okay, do I have to accept, if it's proposal A, the normal scenario would be, okay, do you accept the discount that is being provided or not? Here, the scenario is slightly different. They have already accepted the discount. Now you need to say, did they make a wrong decision when they decided to accept the discount? Scenario is slightly different, but workings will be very similar. Now they've already accepted the discount. You need to go back or reverse working and see, if I don't accept the discount, is it better for me? Then on the other side, proposal 2 also, normally you would be at EOQ. If they do get, let's say, a discount, then is moving from EOQ to the discounted ordering quantity better? Here they've already done the discounting work. Okay? Now they want you to look and say, okay, is it worthwhile for us to reverse and go back to EOQ? Okay, shall we start? Are you okay now? Okay, let's start. Don't look at me, huh? I will help you in a bit, not now. You can start on it. I'll give you 10 minutes head start. Okay, shall we start discussing? Are you done? Part A at least. Finished? What is your solution to part A? No, I'm asking. He said he's finished. Huh? This one got the paper. Okay, let's discuss as we do it, right? Because we don't have time to finish the paper. So, like I told you, here we're looking at it in reverse. The discount has already been taken up. Now you are seeing whether it's good to reverse that decision. Okay. When you come to a scenario like this, it's always best to work out your cost and benefit. Cost and benefit. So you need to identify what is your cost of letting go the discount. So you already have the discount. And what is the benefit of letting go the discount? Right? Now think to yourself and tell me, if I sacrifice the discount, what is the cost I have? What is the cost I have? I will have to pay, I don't know, the 90,000 or what, but I will have to pay something more than what I am paying today. Agreed? Right? I already have a discount. Now I am saying I don't want the discount. So my cost in this scenario is going to be that I have to now pay more cash, which means I have lost my discount. So the cost of letting go the discount will ideally then become the increased payment I need to make, or company needs to make. Does that make sense? What is the benefit of letting go the discount? If I let go the discount, what will happen? I say, okay, I don't want the discount. Then I don't have to pay within the stipulated 10 days. I can take 45 days and make my payment. So what happens then? Ideally, my payable days will increase, which will lead to a payable balance increase, which translates then into, when my payables increase, my working capital requirement will fall. Why will it fall? Inventory plus receivables minus payables. So when you say minus payables is now increasing. So your minus answer will increase further, which means working capital requirement will come down. Right? So in this case, my working capital requirement will reduce, which translates then into saying finance cost reduces. You have to be able to understand this, because if you can't talk about this, you will never be able to work out. Okay. The last thing you should pick up always is a calculator. Now you have Excel cells here, but still assume don't do calculations. First write down what you want to do. You need to know what you need to do. And then the biggest problem is we don't even know what the exam is asking. Second, we don't know what to do with what the examiner is asking. Third, I don't know if I know. You have all three big problems. Okay. So this is what the examiner wants you to do. Very simple. Very simple. Now go step by step. Okay. If I let the discount go off, what is the cost? Increased payment I need to make. What is the increased payment I need to make? I'm getting a discount of how much? 1.5%. What is my total purchase value? 6 million. 6 million. So what is my cost then? My cost, that would be 6 million into 1.5%. Do you agree? Do you agree? 1.5%. Right? So I am now paying 1.5% more than I used to pay. Very simple. So I get 90,000. Now what is my benefit then? What is my benefit? Can someone work out the benefit? When you're working out the benefit, always work current scenario versus your proposed. Right? So 3 things that you will have to work out. So under current and your proposed. So here, first look at payable days. Then you can look at payable balance. And then you can look at finance cost. So what is my payable days currently? Currently I am looking at 10 days. I want to increase it to 45 days. What will happen to my payable balance then? I am having a total purchase of 6 million. I'm having a total purchase of 6 million. Right? Total purchase of 6 million. Now this 6 million, I'm getting a discount of 1.5%. You can either take the discount or ignore the discount, either way. Let's just ignore the discount for now. So you get 164,384 as your current payable balance. When you move to your revised or proposed payable balance, this will increase to 6 million, but into 45 divided by 365. So go to 739,000. What is the related finance cost saving you have? In this case, you are paying overdraft interest of how much? 15%. You are paying 15%. And here also it will be 15%. Right? So if you let go the discount, you will save $110,000 of interest, as opposed to currently you are saving 24,657. So I'm just going to say here finance cost saving. So the amount that you are saving has now increased. By how much? By how much? My benefit is then 86,000. 86,000. This is my benefit. So I will plug my benefit here. I'll plug my benefit here to say, okay, 86,301. Now, is it worthwhile in this case for you to go ahead with proposal 1? Ideally not. So what you can say here is, since cost is greater than benefit, do not proceed with proposal 1. Are we okay? Mister, did you do your revision during the week? Did? Now you remember this. Good. Okay. Right. Now attempt part B quickly.
So, why isn't there any use with annual benefit and over?
You can't we use the annual benefit to annual. Technically you can. You can. But in this case they are asking you what is the net cost of saving. So they are expecting you to do dollar working. Technically you can, but when they ask you net cost of saving in dollars, you show in dollars. Why do you take standard days for proposed? I thought that's what they say. See proposal 1, third sentence. The FD is proposing that KC company reverts to the standard payment terms with supplier A. Your straight away working this answer out. That's also okay. You can do into 15. You can do that test. Okay, work out part B quickly using proposal 2.
Well, possibility, the percentage, what does that mean? 17%.
So if you get 17%, ideally then what you're saying is the cost of my discount is 17% on an annualized basis.
So 17% on 6 million.
Yeah. Hope you're working on part B now. let's discuss part B then. Once again, you can look at maybe your, in this case, there is no real cost or benefit, but you will have to quickly work out the total cost of inventory at EOQ and the total cost of inventory at current order quantity, right? So total cost of inventory at each levels. First, you can do it at current 20,000 units, and then at EOQ. So we don't know what is EOQ, so you can quickly find out EOQ. So EOQ, you can use the standard equation. So in your Excel or in your spreadsheets, you can say SQRT to get square root into 2 into C naught. So what is C naught in this case? Cost of ordering. So cost of ordering is being given as, that's it, 45, and cost of holding is given as 1.2, and your total demand 10,000 per month. That's 120,000 in total, right? So you can say 2 into 45 into 120,000 divided by CH, which is 1.20. Put an additional bracket in the front, secure the working. So get EOQ as 3,000. So here you can start working out at 3,000 how much you would get, right? So we can start off with purchase cost. Purchase cost will ideally be the same. No, it will be different because you're having a discount, right? So purchase cost at 20,000 units will be cheaper for you. So how much is the purchase cost at 25,000 units or 20,000 units? Your standard purchase price is 0.5. You're getting a 5% discount. So you'll multiply by 0.95. That multiplied by the number of units you're purchasing right throughout the year, 120,000. So you get $57,000. At EOQ, no discount. So 0.5 into 120,000 units, it will give you $60,000. Right? So you're using the 5% discount. Then calculate holding cost. So holding cost is cost of holding 1 unit for 1 year. So that is CH is 1.20 into average inventory. So that is 20,000 divided by 2. Get 12,000. Under the EOQ model, you will get 1.2 into EOQ divided by 2. So that is 1,800. Ordering cost. So here it will be cost per order into number of orders. How do you find number of orders? Total demand divided by order quantity. 270. And then check if the answer is correct. No? And then finally you will have 120,000 divided by 3,000 into 45. Ideally at EOQ, holding cost and ordering cost has to be the same, unless and otherwise there is some sort of buffer stock. There is buffer stock, holding cost will be higher than ordering cost. Otherwise, at EOQ, always ordering cost has to be equal to holding cost. Ideally, you don't have to calculate ordering cost, you can just say 1,800. But just to be sure, you can always do the work. Okay. Okay. So you can take total cost. Let me show you the formula. I don't know if the working is wrong, but so 12,000 would be ideally your cost of holding 1 unit for 1 year is 1.2. Cost of holding 1 unit is 1.2 multiplied by total average inventory. That is 20,000 divided by 2. So you get 69,270 versus 63,600. So the benefit of moving to EOQ can be seen as 5,670. So what you can say is, you have to write a statement to say the savings from moving into EOQ is at $5,670. Therefore, proposal 2 should be accepted. Okay, I'm good.
Three types of section C questions. C.
Oh,
C.
I think
There aren't any other types.
there is
MPV. Okay. This type.
this one,
And then the what we did last week.
cost of capital.
Yeah, that's all.
You may get business valuations.
But I didn't find any.
You get
But it hasn't been tested.
has been tested.
But like
Valuations will come.
valuation.
Debt valuation or equity valuation. One of the two will come.
But Kaplan has only categorized it into three.
Syllabus says so.
But we won't get this one, right?
Risk management. They can put it like a three. They can put some small sentence into that and make it come into the sections. But it won't be the entire 20 marks. Okay. Right, so let's move to part C. Part C is asking identify and discuss 3 techniques that could be used to monitor and manage cash resources in the future. Here they are asking about 3. So you have to write down 3 and each point has to be for 2 marks, right? 2 marks. Okay, obviously the first one is what are you going to say? Use cash forecast and cash budgets. So number 1 you can say cash forecast and cash budgets, right? Cash forecasts and cash budgets. Then you can quickly explain how this will help you. So you can say this will help a business. This will help business manage its cash position. Manage its cash position. Manage its cash position. Full stop and say a cash forecast is simply a cash forecast is simply an estimate of cash receipts and payments. Cash receipts and payments. Cash receipts for a future period. For a future period. A cash budget, on the other hand, is a commitment to a plan. Is a commitment to a plan. For cash receipts and payments. For cash receipts and payments. So stop and say cash budget should be prepared annually. And a cash flow forecast prepared and reviewed regularly throughout the year. Prepared and reviewed regularly throughout the year. Next one. What's the second thing that we can do? We maybe use the cash management models we learned. Two models we learned. One is Baumel's model and Miller-Orr model. Okay. So we'll say first one Miller-Orr model. Miller-Orr model. That's the graph, right? Yeah, lower limit, upper limit. Miller-Orr model. You can say that the cash balances are likely to fluctuate. First of all, say management. We'll set lower limits. And based on the higher limit and spread, we'll look to invest in short-term securities. Or sell short-term securities. Depending on the cash position. And third one you can say Baumol model. BAUMOL, Baumol's model. Cash is managed similarly to inventory. And it looks at how much cash should be transferred in, and out, in and out. Of short-term investment account. Short-term investment accounts. To avoid excessive balances in current account. Okay, read through now. See if it makes sense. Then we move to question.
Can we like say it uses the EOQ?
Sorry?
Can we say it uses the EOQ?
Yeah. It is ideally the EOQ for money.
Yeah.
You can do one, but
Can you give them, I mean, what's to do?
I have one more work I can give them for you.
It also Sunday, right?
Yeah. Okay, let's start with the next question. Question number 32. So it says March company operates and manages a number of theme parks. The capital structure of March company as at 1st January 2021 is as follows. Issued ordinary shares are 250 at 25 cents each. So it will be good for you to quickly compute what your total number of shares are. Total number of shares are. So if you take 250 and divide by 0.25, how much do you get? So I think we have 1 billion shares. So this is 1000 million shares. This is 200 million shares. Then you have your bank term loan 200 and 8% irredeemable loan notes at 400. The ordinary shares have a current market price of $2 each, and dividends per share, that is in cents, in the 5 preceding years were as follows. The ordinary dividend for 2020 has just been paid. The bank is currently charging 10% on the term loan. Preference shares are currently priced in the market at 0.7 per share, and the dividend is just about to be paid. The loan stock had an ex-interest market price of 75 against the nominal value of 100. The company pays tax at a rate of 30%. Calculate a suitable discount rate that March company could use when appraising new theme projects. What do you think we should do here?
Equation.
What long equation? Ideally use your WACC. So here you are expected to use WACC. But when you are doing your WACC computation, like I told you some time back, it's always nice to write down your equation for WACC. In this case, you have cost of equity and value of equity. You will have cost of preference shares and value of preference shares. You will have cost of irredeemable debt into value of debt. Maybe in this case you take post-tax. So KD 1 minus T into value of debt plus cost of bank loan post-tax into value of bank loan. This entire thing you can divide by value of equity, value of preference shares, value of debt, and value of bank loan. Okay. Right. I'll give you 5 minutes head start. Start quickly. Kumdi price. No? They given you the preference shares are currently priced in the market at 0.7 per share, and the dividend is just about to be paid. That's your Kumdi price. They'll always use the equity price.
Have to say Kumdi.
They say about to be paid. About to be paid, it's your Kumdi.
The market changes according to the dividend.
For which one?
K.
KE. I took the whole
5.9.
5.9. You check the brackets. Check the sufficient brackets. I will check.
Should we put 10.5 or 0.10?
10.5 is given in cents. That's why I took it as in dollars.
It's 8.5.
And then you divide by 2. Why do we multiply by 10%? Which one? I'm sorry. Which one are you talking about? Sumaya?
What's the KD of irredeemable loan? What's the KD of irredeemable?
KD of
Irredeemable.
irredeemable debt. That is this.
47.
Yeah.
So I thought of making it like a table. So it's something.
Okay. That's it.
Seems like easy on the iPhone.
Anyway, you need to look at how you present it. Not. Okay, shall we discuss? Okay, Mister. Happy? For preference shares, Sumaya, we multiply by 10% because it is a 10% preference share, which means your dividend rate is 10%. So on your dividend rate, 10% in the sense, you calculate your dividends on your nominal value of 50 cents per share. You take 10% into 50 cents per share. Clear? Okay. But part B says discuss the fundamental assumptions that are made whenever the weighted average cost of capital of company is used as the discount rate in NPV. We calculate that 14.614. You got that answer? No. I'm still doing it. Sorry. Do it. We first finish it, then we'll move to the next one. Loan notes 7.6, 7.46 I got. Still can see. 7.56. Small calculation difference. Just check if you got 18 to 1 minus 30% divided by. Or you divide by 100. Okay.
Okay.
So section A is like the most trickiest.
That's why you do it last. I think like the way my observing is going to be tactic. No, that's a use secure for let's say 36 marks from section C. That is the target. 36. Yeah, 18 agents. So 20. 20? Then stay at home. Secure 20 from section C. Section C minimum 30 marks. Minimum.
Section C.
Minimum 30 out of 40 you would get. Otherwise stay at home. Don't go for the exam. Falling sick. What? Can? You're a doctor who gives fake medical. But secure 30. Don't go to the exam without assuming. Don't just go to the exam and say, okay, I'm only going to get 20 from section C. Then stay at home. Don't go. You're putting yourself in. Waste of time.
P naught is 250.
Equity P naught is 2. You're doing the same question I'm doing. It says just below the table, ordinary shares have a current market price of 2. Where did you get 2.5 from? Yeah.
Total.
250 is the total book. Total book.
Yeah. It's 200 market.
That's the problem.
Cost of capital is 6.3.
Cost of capital is 14.6. Back on I'm saying 6.
But the cost of bank loan 7%, right?
So see, if you have the what is the lowest cost of capital you have? 7%. Can your WACC be below 7%? Your WACC has to be between the highest and the lowest rate. Highest here is 16, lowest is 7. Has to be somewhere between 16 and 7. In this case, 14. There must be some calculation mistake. I
Alternative ordinary share 2000.
yes,
Preference share
130. That's because you forgot to deduct the dividend. So, like, how many marks would you lose if you make that? 1 million.
Yeah.
1 mark.
0.65.
6.5.
And then
So how much is there?
14.61.
Like 0.07.
How come? Check your markup values.
the cost of capital ordinary share 5.9.
No. 16.8.
Your market value is there.
Cost of equity is correct, 16.89. Okay. Preference shares 7.69.
Yes.
Bank loan 7%. Individual loan note 7.46. Then your calculation is. You must have multiplied something else with something else.
25 cents, right? In dollar mean 0.1.
0.105.
Growth is 11%, right?
Growth is 11.067. You can, but when you have Excel, right? Just click the cell, no? Link it. Then you get the whole decimal. There is no accurate. Sorry, what were you saying? Yeah.
So when you're finding growth, when they're given like periodical growths, can you like use the growth between just 1 year, still 11%?
You can, but it's not as accurate.
Will I lose marks? No, right?
I don't know whether you lose marks or not. Depends on what the exam feels at that point in time. But the most accurate estimate would be to take the last and the first.
All
16.8 KE. Then B KB 7.7.
Yeah.
Lower not 7.5.
7%. You have to take it post tax. 8% into, sorry, 10% into
Not 10%, one not 8%. 8.
alone notes. Sorry, yeah, okay, 8%.
8%, 1 minus 30%, divided by 7.
Yeah.
Chance 7.5.
Lower notes is 7.5. Yes.
Then market value 2000, 130, 300, 200.
Yeah. You still don't get the answer. Almost got it. Almost winning is never a win, na? Don't forget. Something like that.
To understand the range, the examination, how often can you be? Like your
Decimal place off is okay. Whole number off is the problem.
it's got to be between 14 points.
14.5, 14.6, 14.7 should be okay.
If we do the KE in the can line directly with the percentage,
I can give you an example. I can't tell it in class. I'm outside class, I'll tell you.
because find by solving the equation directly in the case.
A more discussable example is you have put at home, but you still go outside to it. Got the answer?
Everyone does that.
Huh?
Everyone does that.
Can do in the Excel.
Huh? That's why I said that's a more discussable answer. There are other examples I can give, but not in class, especially when it's recording and they're putting this on YouTube.
Excel is using Excel is like the most easiest.
Yeah. Don't use calculator, throw the calculator. Section B and C you can use. A and B you can use. C don't use. Do every damn thing on the Excel. Putra, what happened to you?
So the KE
I'm making a discovery. Whatever. Don't use the calculator. The calculator. Section C don't use. No? Section C you throw the calculator and then do section. After that you pick the calculator and do section B and A.
so the Excel formula for KE.
KE. What's the problem? No, tell me what you have done. I can't see from here. That's your problem.
The equation is PO equal
KE is equals to D naught into 1 plus G divided by P naught plus G. Yes, my son, what happened? Okay. No problem. Now full confident, no? Tomorrow last class, huh? Why? After exam also one class. Tomorrow is last class. Because I think after that, next week is 30th and 31st. Then first is exam. That's for you. Others have audit. Exam for all is 5th. Friday. Okay, done. Okay, shall we move to part B then? Discuss the fundamental assumptions that are made whenever the weighted average cost of capital of a company is used as the discount rate in NPV calculations. Now tell me, 5 marks, okay? What are we going to write in?
What's the question?
the growth is constant.
Read the question properly and then answer.
There is no business.
Ideally, I think I gave you that matrix no last time. Okay, just apply the same matrix here. First point is finance risk has to remain constant, which means capital structures won't change. Number two is you operate in the same business environment or business risk remains constant. Those two will be covered from the matrix I have given you. Right? The number three would be you are always using, or rather project finance is not project specific, but you are funding your project from a pool of funds. A pool of funds. Those three have to be written no matter where you go. Okay. So those three assumptions for WAC are compulsory. You have to write those three assumptions. Okay. You'll write those one.
Business risk, finance risk.
The funding for the project is from a pool of funds, not project specific. If you're using project specific funding, you have to calculate APV.
The business is in a finance business.
Constant.
So why is that like assumption?
Because what you assume is your WAC will remain constant if you are using from a particular fund that you already have. But if you take project specific funding based on the risk of the project, your funding cost of capital for that funding that you take will change. For example, if I am going to take up a risky project, ideally my project funding has to be more risky. But if you take it from a basket of funds, it will be based on your entire business risk. Okay. So we'll write those three first because those three are important. After that, what you write, I don't care. You write your name also, no problem. First one you have to say is capital structure. Capital structure has to, don't just say finance risk is constant. Huh? Don't do that. Or don't say business risk and finance risk should not change. Don't do that. That is just for you to remember. You have to write it in methodical. You have to say,
There is the dividend.
that is only for cost of equity.
They will do the
But you can use CAPM also to that. Okay. But, you can say capital structure has to be maintained. Capital structure has to be maintained. Meaning, or you can say that is financial risk and gearing are constant. Financial risk and gearing are constant. Then number two, you can say
So
financial risk or gearing is constant. Both are the same. The project has the same risk, has the same risk as the current business activity. As the current business activity. Number three, the funding for the project comes from a pool of funds. And is not project specific. Not project specific. Fourth one you can say objective of the company is to maximize shareholders' wealth. And the last assumption you can say cost of equity and cost of debt. Cost of equity and cost of debt. Use perpetual assumptions. Use perpetual assumptions. Assuming company will exist in perpetuity. Company will exist in perpetuity. Okay. Read through and see those 5 top 3. So if they ask you assumptions, always write the top 3 has to be written. Na? Don't write anything else without writing the top 3.
So I was doing a section C question. Came across the 6 marks question like Murtaba and the other thing.
Murtaba is what you eat. Mudar.
Blah.
Islamic.
So, right?
Who?
In
Yeah. So you write about Islamic financing. So if I gave you
like asking the difference between those.
between Mudaraba and
Other-
what are the things?
One thing is like the investor, I remember the investor has control, he doesn't have.
Okay, so that is Mudaraba.
The difference between those two and choose which source of finance.
You can just send me the question. I'll tell you what.
Now I know the market scheme.
Ah,
It's tough to remember. So that's
it's not very good. Just before we go to the exam, read those Islamic terminologies and discuss whether March company could increase shareholder wealth by reducing its weighted average cost of capital to a minimum level. What do you think is the answer?
So that's the question.
Part C now. Discuss whether March company could increase shareholder wealth by reducing its weighted average cost of capital to a minimum level. Ignore tax in any model discussed. Huh? Yes. You? No. Yes. What do you think? No. Yes. You can't just say yes.
Yeah.
You have to say
Why?
yes and no. Both. Not why. There is yes and no. In discuss.
No, because eventually weighted.
No. Now see what they are putting in the bracket there. What are they saying? Ignore tax in any model discuss. That's a clue. You have to use M&M without tax. M&M without tax says what? No matter what your capital structure is or whatever happens to your WACC, market value won't change. Market value is dependent on the cash flows you generate. That's what Modigliani and Miller says. So reducing your cost of capital to a minimum level will not help you, as per Modigliani and Miller, to increase shareholder wealth. But the traditionalist theory says there is an optimum point. That optimum point you have to be able to find. That is the point at which your WACC is minimum. Then your market value will increase.
So why have they told us to ignore tax?
Because if you use tax, Modigliani and Miller with tax, then they're expecting to write an answer for that also. So there will be 3 models. Here they are asking you to discuss 2 models. That's all.
What's the tax model?
Modigliani and Miller with tax says increase debt exponentially up to 99.9%. Then your WACC is minimal and your weighted average, market value will increase to its maximum.
But there's criticisms for that as well.
There is.
Like as capital increase, like the risk use.
Modigliani and Miller without tax and traditionalist.
Traditionalist also ignores tax.
Yes.
Sir, this is being perfect mark.
It should be perfect mark.
That's an assumption.
We can tell them.
You can write that also. Okay. So we'll write an answer quickly.
So is the marking like structure half a mark per point or is
1
it
mark, right?
one or nothing?
But in this now they're giving you 5 marks. No? So you have to understand how you want to structure it. You have 2 theories to discuss. Okay. Don't do 3 and 2. Meaning don't write 3 marks for one theory, 2 marks for one theory. Don't do that. Write 2 marks for one theory, 2 marks for the other theory. There is 1 mark remaining. What is that 1 mark you will do? No.
Application.
No.
You apply to the case.
You have to first discuss the statement they are talking about here, which says increase shareholder wealth by reducing VAT. Ignore any model. What you need to say there is the market value of a company will be dependent on 2 factors, which is cash flow and VAT. Right? Because you assume company will remain in perpetuity. Right? So you find the present value using cash flows over VAT. So you establish the equation. Then you bring in Modigliani and Miller to say that they say no matter what happens to WACC, the market value won't change. Right? If you want to change your market value, change cash flows. Then you bring in traditional view and say no, they said something. Okay, let's do that. So again, first point is you determine that there is an equation which says market value of a company is equals to cash flows divided by VAT.
So like first point,
Present value of perpetuity.
so like first point we have to establish the relationship.
Correct. Okay, so we'll say that the market value of a company, will be equal to, this is the equation I told you, Asmat, to write in your bed and keep, read 3 times a day.
I have written it, sir.
In your bed.
No, on my wall, like on top of my laptop.
Good. Are you reading 3 times a day?
More 10, 20. I made the formula, sir.
How many formulas, sir?
96.
96 formulas.
Right.
Don't give it to anybody.
Huh?
Don't give it to you.
Again,
They want to charge.
2000.
That's your choice. What I told them to do was the start of the session to take an A4 paper, fold it into 2, so you have 4 sides. Start writing down all the formulas. So when you're revising, you just have 1 paper to refer to all your formulas. I told him there will be around 80 to 90 formulas. I asked him how much? 96 formulas. Your entire syllabus has 96 formulas. Yeah, out of that, I think 10 are you. Remaining 86 you will do. Okay. Right. So we'll write there market value of a company will be equal to the present value of future cash flows. Present value of future cash flows discounted in perpetuity. So stop it, say the discount factor used would be the VAT. Discount factor used would be the VAT. Then you can write down the equation. Market value equals to cash flow divided by VAT. Market value equals to cash flow divided by VAT. Okay. Then you can say things there. Then you can say therefore if VAT is minimized, market value of the company will be maximized. Market value of the company will be maximized. Full stop, and you can say next line. Modigliani and Miller. Modigliani and Miller. You can write it. Modigliani and Miller. In their theory without tax. In their theory without tax. Argued that a change in capital structure would not impact WACC. Would not impact WACC. And therefore would not impact shareholder wealth. Would not impact shareholder wealth. Let's stop and say rather, Modigliani and Miller stated in order to increase market value, the company should focus on cash flow generation. Okay. Then you can say parallel. So you can say on the other hand, next line, on the other hand, the traditional view suggests that reducing VAT to a minimum level, will maximize market value of a company, but does not give a prediction as to where the optimal gearing level would be at. Okay, let's read through and see if that makes sense. Okay.
So break.
Okay, let's take a break.
They put running in prison, right?
They put running in prison. Yes.
Okay. Fast track that point.
I just want to get to 60 and retire. Okay, section B. Which one shall we start off with? There are 3 questions. What is the first question on NPV? The second question is on Forex. The third question is on valuation. Which one do you want to start? Valuations. We'll start with valuations. Okay. So question number 26. Okay, let's do it. So it says the following scenario relates to questions 26 to 30. The directors of Park Company are considering making an offer to buy 100% of the shares in Ride Company. A company extracts from the most recent financial statements of Ride Company are as follows. Statement of profit or loss for the year ended 31st December 2015. Profit before tax is given. Tax is given. Profit after tax, dividends that have been declared also given. Statement of financial position as at 31st December 2025. Freehold land and buildings, plant and machinery, current assets, share capital. Retained earnings, 6% redeemable debentures, current liabilities. Additional information, a recent independent valuation of some of the company's assets showed that the land and buildings were worth 9.6 million and the plant and machinery was 3.2. The current asset balance includes a receivable of 0.2 million from a company in liquidation and some inventory worth 0.4 million, less than its carrying value. Some research into listed companies in the publishing industry shows the following: average P ratio, average dividend yield. Okay. Calculate the total equity value of Ride Company at 31st December 2025 using the net asset base revaluation. Okay, quickly do that. Tell me what the answer is. We'll do question by question. It's easy. What is the revaluation net asset basis value of the company? You can remove it out as bad debt from your contract. Because there's a liquidation. So they are bankrupt. No need to study this. This question no need to study. You just read and see. You can. Don't give up.
It's valuations.
If you know cost of capital, you know business valuation. And this net asset valuation, if you know balance sheet, you know the answer. What is net asset? Current asset, sorry, total assets minus total liabilities. Total assets when you are born. Okay. Ideally, you should get 6,300 as per the working I've done here. So freehold land and buildings will go to 9,600. Plant and machinery will come down to 3,200. Current assets will be revised to 3,700. That's 4,300 minus 200 minus 4. Right? Then you don't have to consider share capital and retained earnings because that is part of equity. Your liabilities will remain as is 8,000 and 2,200. When you do the math, you should get 6,300. Check and see. So ideally, my answer is B, 6,300. Calculate the value per share of right company at 31st December 2025 using dividend yield method. Show your answer to the nearest cent. So it means you need to do decimal places. What is dividend yield now? Dividend yield is
3.
Now, what does dividend yield mean? Dividend over?
That's the market value.
Yeah, not market value, cost of equity. DPS over NPS. So, what is your DPS here? Or you can compute as total dividend. What is your total dividend? Total dividend that we have paid is 250,000.
DPS
Dividend yield is DPS. Earnings yield is EPS. P ratio is NPS over EPS. Okay. So what is your NPS? Market price per share. In this case, we'll have to take total market value, total value of share. What is the total value of your share?
So here
they are giving you share capital 500.5. That will be number of shares, right? 1,000. But in this case, they are asking you to calculate the value per share. So MPS is what you are trying to find out. Dividend yield is already given. Check here, 3%. So what you can do is equals into 0.03. You can rearrange this to get MPS 0.03 into 250, which is how much? Sorry, divided by 250. The other way. 250 divided by 0.03. How much is this? 8,333. They are asking you per share. So take 8,333 divided by number of shares. How many shares do we have? 1 million shares, or we say 1,000 shares? 1,000 shares. So this is 8.33. So your answer here is 8. Okay, clear? You don't look happy.
dividends per share, right?
You can take dividends per share or total dividend, either way.
Dividends per share means 0.25.
Yeah.
0.25.
Divided by 0.03.
0.0.
Okay. Which of the following statements is correct about valuation methods? Net asset revalued method would tend to overvalue a business such as right, ideally undervalue. Right? So this is wrong. It will undervalue. The dividend valuation model is usually only used to value a minority interest. Ideally correct. Dividend valuation model is minority.
What's a minority?
Minority is people who have less amount of shares. You can't influence the earnings of a company. You only have to look at receiving the dividends and be happy with it.
P is the majority.
Earnings is majority. Income-based valuation methods such as P ratio method are particularly good for valuing majority share, not minority share. When using the P ratio method for valuing a private company with few internal controls, the P ratio of a similar public company could be used and adjusted upwards. Now you can't just adjust upwards. You look at the factors, adjust up and down, both. So D is the correct answer. 29. The following statements about market efficiency have been matched against the type of market to which they relate. With this form of efficiency, there would be no need to ban insider dealing. Insider dealing is always strong form. So the first statement is wrong. Share prices follow a random walk, so future price movements cannot be predicted from past price movements. Correct. With this form of efficiency, the share price is not always an accurate reflection of the available information. Not always accurate reflection of the available information. It has to be an inefficient market. Correct. The only way to beat the market would be to trade in the first few minutes of news about the company being published. This is wrong, has to be semi-strong. Okay. So ideally statements 2 and 3. Okay. Last one. If the return required by the debt holders of right is 7.5, calculate the market value of irredeemable debt. Okay, how do you calculate market value of irredeemable debt? Interest divided by KD. Okay, quickly compute. Don't take interest post tax, only pre-tax. I told you that day, valuation always pre-tax, cost of capital post tax. Keep that in mind. Huh? Okay. So here, what is your interest? They are saying 6% irredeemable debentures. So don't forget, interest is always computed on nominal value. Nominal value is 100. KD is 0.075. How much do you get? 88. 80. So $80. Simple. Huh? Interest percentage is 6%. Why is it 6%?
Oh, why that?
Why I multiplied by 100? Good question. You will always calculate interest based on something called nominal value. Okay. Always based on nominal value. Your nominal value is 100.
Always.
Unless otherwise stated at the exam. Always 100 unless otherwise exam says something. Okay. Shall we go to Forex then? 20? 6.3. 6.3 is based on this working. Freehold land is 9.6 million. Plant and machinery is 3.2. Current assets will come to 3.7. That is 4,300 minus 200 minus 400. Then I will ignore these two because this is part of equity. Liabilities will remain as is. The difference is 6,300. I'm a mental math. I don't.
Debentures is full amount.
We have to know.
Have the interest.
No. Your liabilities. Net asset is assets minus liabilities. Forex. Okay, start on Forex. H company, a UK company, is in the process of negotiating an order worth 1.4 million with a large US retailer on 6 months credit. If successful, this will be the first time that H has sold goods into the highly competitive US market. So, which means they are planning to receive $1.4 million. The company's treasury department has provided the following spot rate and 6 month forward rate. Immediately delete what is not required. So this is your buy dollar rate. This is your sell dollar rate. In this case, what are you doing? Are you buying or selling?
Selling dollars.
Selling dollars. So when you are selling dollars, you will delete the buy rate. No point looking at that buy rate also. Not relevant to you, no? Not relevant. Okay. And UK buying borrowing rate and deposit rate, US borrowing rate and deposit rate. Very simple. Now working to the nearest thousands, how much would H receive in pounds in 6 months if they use a money market hedge? Okay, quickly work and tell me. Always do this, delete the irrelevant rate. Otherwise, while you're working the question, you'll be like, oh shit, now what is the rate I'm supposed to use? You've already done that now. You're only looking at one rate. Very simple. Huh? Don't make life difficult. Life is simple. You only complicate. Finished? Now here you don't have to show workings. So just scribble it and quickly do it. Don't try to draw beautiful arrows. Don't take rulers to the exam. Don't do that. $720. We'll do the working, but I want everybody to finish. You can continue. Please. I don't know. How should I know? 720. Okay, so basically find first step present value of 1.4 million. So this would be, so this is for how many months? It will be 6 months credit. So this is annual rate. So divide by 2, this is 2%. Divide by 2, this is 1.5%. Divide by 2, this is 4%. Divide by 2, this is 3%. So we are looking at receipt. So you need to create a liability today. So you're going to borrow. Borrow means 4%. So 1.4 million divided by 1.04. Get 1.346. Convert that to what rate? 6 divided by 709. 72266.
So what's the four-way equivalence model?
Four-way equivalence model is maybe drew that big diagram with PPT on one side, IRPT on one side. Last week we did one question on that. Last Sunday.
Like by
Refer to that. That's a good question. I think section A, the last question. Remember that.
last question.
Yeah.
I think last week I logged off.
Yeah, I saw you. Correct? We did four-way equivalence last Sunday, section A, last question, right? You absent? Well, online also you're not there. During was recording. You slept. Whole week you slept. Hibernation. You're bored there. Okay. Question number 22, quickly. Calculate to the nearest pound the sterling receipt for H if they invoiced in dollars and used a forward exchange contract. Now this you don't even need 1 minute. You can quickly do. 742. So ideally you take 1.4 million divided by 1.8860. 1.4 divided by 1.88614. 742312. Correct? Don't forget you have to put to the nearest pound. Don't forget that part. So 742 3117. So 312.
3.6 minutes for his question.
3.6 exactly. So I told you this paper you can finish in 2.5 hours. That's half an hour. You can sleep or you go home.
Go home.
What? Huh?
Till the exam is over.
They don't let you go now. If you finish early, you can write. If you finish,
Because they are telling when we go out, the other people will disturb. So we should.
Like,
They'll
I always said that.
they'll get scared.
After my exam, I don't stay back and discuss. But now you don't have to discuss because everybody got different questions. I don't stay back and discuss also. I leave. They used to give 15-minute allowance. At let's say exam is finishing at 1 o'clock. Before 12:45, you leave the hall. After 12:45, you say you finished. They say no. 15 minutes you have to wait. So I always finish 12:40. I run and go home. Because my friends will try to call and say what happened to the exam. I don't answer the book. We were privileged. Okay. Sometimes my mother also asks, how come you came so early? Sometimes before the exam finishes, I went to. Okay. Huh?
All papers.
I go late, I come early. Everything. Okay. First, you remove the pressure out. Huh? If you go with lot of pressure and stress at the exam, you will fail. Before you go inside, I'll tell you. You leave the pressure at home, leave the stress at home. Casually walking. I don't take a bag when I go to the exam. I only take a calculator and a few pens in my pocket. That's it.
We can't even take pens now.
Yeah, now you can't take, but before we could. That's all I used to do. I used to just go. Now you don't need anything. You don't need bag also. You just need your ID and water bottle. Carry no need. Why do you carry? You can use the. If you are comfortable with that, take a calculator. That's it. Just casually walk in, like you're going to have a meal or something. You go to a restaurant, watch a movie. You know how casual you feel.
Yeah, what's it?
I don't know if you're allowed to wear shorts, but okay.
Can you go like that?
I don't know if you can. You can't.
You go
You have to wear shoes, no?
No.
You can't. You know to wear shoes. I don't know, but make yourself very comfortable the way you dress.
Go with the Lincoln suit.
And chill. Don't stress out too much. Okay. Look at 23. Now see how you're quickly working the questions. Because you're not stressed. No? Relax. That's how you should do the exam. Keep the stress at home. Relax. Day before the exam, ideally stop studying. No point, no. On the 4th, stop studying. Throw the books away.
We like miss out on 1 mark.
Can't help. That one day won't make a difference. The exam on. I used to sleep. If my exam generally was evening, 3 o'clock. Morning till 12 o'clock, I sleep. Till 12 o'clock, nobody at home disturbs me also because they know he is sleeping. He won't get up. Before the exam, I is in sleep because your brain needs rest to think at the exam. Sometimes the exam becomes a doosra. Your brain is tired, bold of you. You have to be well rested, drink a lot of water, pay at least one visit to the washroom. You could do good ideas, huh? You go to the washroom. Huh? Yeah. During the exam, I used to always go. I have a 10-minute break anyways in the exam. That's me. I don't know about you, but that's how I relax. Don't take stress. No. Because if I fail, one thing is I always tell my mother, I'm not going to take it to my grave anymore, so don't worry. Number 2 is I used to pay for my exam fees, so my mother can't say anything I do. Okay. Complete the following statements. If the exchange rate were to move to 1.8870, 1.89 per pound in 6 months' time, the exchange gain or loss compared to today would be how much?
2,734 loss.
Why 2734 loss? Exchange rate today is how much? 1.897. No? Today it is 1.897. You need to compare it against 1.890. 1.890. So ideally your exchange rate is coming down, which means your receipt has to increase, which means it has to be a gain. It can't be a loss. So ideally these two answers are not applicable. Now how much is the gain is what you need to check. Okay. So if you did not hedge, you would get 1.4 million divided by 1.89. How much is this?
So
738,000. Okay. If not, how much would you got? 1.4 million divided by 1.897. How much is that?
Can you use the difference and calculate?
that is 740.
This is 740. This is 738.
740.
Okay.
This one is 738.
Okay. So I did something around 2000. So 2734 is your gain.
So where do you get the 1.897?
1.897 is what we discussed before. No?
And if we got 720, right?
No, that is if you hedge. No,
Yeah.
this is without hedging. You do not hedge. That means you use the current transaction and the future rate.
We don't use the forward.
Sorry, one second. What is it?
We not hedge.
Yeah.
We not use the hedge is fixed, right?
If you hedge, it's fixed.
And we don't use the forward.
No. If you hedging, you can use the forward or the money.
Okay. In hedging, okay, you have both.
You have multiple options to hedge. No,
This money.
no.
The first. The
Forward is also. Okay. Question number 24. Which two of the following statements are correct about methods of dealing with foreign currency risk? Which two of the following statements? Future contracts and forward contracts can be traded. Future can be traded, forward can't be traded. So this is wrong. Currency options give the right but not the obligation to buy or sell currencies at some point in the future at a predetermined rate. That is correct. When using a money market hedge to hedge a future payment, you borrow the present value of the foreign currency amount today, translate this into your home currency and place this on deposit. Future payment, you have to not borrow, you have to deposit today and later borrow. So this is wrong. A forward exchange contract allows flexibility with regard to the amount to be covered and the settlement date. Forward exchange allows, no? Futures only don't allow. How is it flexible? A future will tell you you have a contract of 65,000 pounds only. Your dates, futures will tell you it's every 3 months, March, June, September. Forward, you can do it whenever you want. You can do it at whatever value you want. If an importer expects the currency it is due to pay in will depreciate, it may decide to settle early. Wrong. It will decide to defend, pay later. Okay, so I think B and D are correct. Okay.
So, but it's not like the D part. It's not like the bank will agree.
Forward exchange is when you want to do it. Futures only it's fixed.
Will they agree to the amount?
Okay. Which of the following statements are correct? H, a UK exporter trading with the USA and invoicing in US dollars would prefer pound sterling to be strong. Now this is a UK exporter. If a person is exporting, he would like the dollars to be strong or pounds to be strong.
They want the dollar.
He'll want the dollar to be strong. Exporters. So A is wrong. If A is wrong, ideally B has to be correct, I think. No? UK exporter trading with the USA and invoicing in US dollars would prefer the pounds to be weak.
Yes.
That is correct. Okay. Sorry, they're asking 2, no? So 2 has to be correct. Okay. What's the other one? H US customers would prefer the US dollar to be strong if H were to invoice in pound sterling. US customers. For the US dollar sterling. Ideally correct. Yes. Opposite of exports. So B and C are the correct. If which one? B or C or C? Export or importer? If you are an exporter, if they are giving out, so then we would prefer the dollar to be strong, which means we will receive more dollars. In other words, we will prefer the pound to be weak. Okay. Quickly do the last one, then NP.
If we invoice in the home currency,
You will probably lose the custom. Okay. Quickly do 16 20. What's the problem?
So which type of question did they test in this?
Which type of?
Question did they not test?
They tested everything. Valuations we did, forex we did, NP we were doing now. Business valuation, cost of capital we did, working capital. All 5 types.
So they are test all fine. Anyone test?
They'll test, as I said.
They will test all fine. But in section C, they would.
2 only can come.
Three types in section C.
No, only 2 questions can come.
NPV, middle.
To get NPV or sort.
No, but the theory.
he was the recording, but he can't apply the theory knowledge to the questions.
For which subject, which topic?
All that.
Entire.
He was recording.
Then my suggestion for you is keep doing questions. Keep doing questions. That's the only thing. Now you don't have time to
We
read.
already.
What's the recording here? You didn't go for lectures. That's it.
All recorded.
He can't apply the knowledge to the question.
Do questions. That's the only solution you have right now. Don't watch recording again. I'm very honest with you. Don't watch the recording.
Sir,
Okay, start on this 16 to 20. Finish all 5 and then we'll discuss. NPV, you should be able to do. Huh? You want to relax your mind. Huh? What do you want to relax your mind? Someone massage your head? I'm sorry, I didn't read the question. The NPV of the investment proposal is it constant cash flows? Producer. Yeah, you can use annuity, no? It's all consistent. Are you fishing outside the class? I had a friend who looks just like you. By any chance you know Tasvir? He was lecturer here sometime long time, sometime back. He looks like you. Okay, soon do. We'll discuss once you're done.
They are short focusing on my team.
Unfortunately, we are looking for short. Yeah.
Yeah. Sales.
Hmm?
Total sales.
Total.
Sales.
Yeah. Present value. Present value of tax. Not the total tax. Present value. Multiplied by the discount. Huh? How many to do? Do it man. Huh? So do an Excel. Life is so easy.
You told us to chill.
Hmm?
You told us to chill.
Yeah, chill. Do it on Excel. So easy. Don't be lazy. If you're lazy today, you'll be lazy in the exam also. Definitely. Habitual. Keep trying. Whatever said and done, answer all the questions. Don't let anything blank. If you don't know something, write your name here. No problem. That's what my dad used to say. You go to a question, exam, don't leave anything blank. Write your name at least. Don't physically write your name. It means you write something.
Time is very crucial.
If you follow my methodology of answering the paper, you will never lose time. 100% correct.
Anyone can see. So section C, 1.5 allocated.
1.5 hours, what I will write so much into section. 36 marks, 36 minutes, 36 minutes. That is 72 minutes. 72 minutes is 1 hour, 12 minutes. Maximum. Yeah. I think you will finish in 45 minutes. After the exam, you message me and tell me how many minutes you took. Ideally, you will be able to do the paper 2 times. Very
For
well.
me.
Okay. You do it, man. You can plan your lunch after that. Our depreciation is 25%.
Annoying.
Huh? That is annoying. Can't help, no, we have to do it. What was the tax allowable depreciation?
30.
25%.
I think I made it.
Don't make mistakes.
So we can like do this in section C, right?
What do you mean?
Computation in section C. So it's easy.
Yeah. Are we paying in arrears or same year?
Arrears 1 year.
1 year arrears?
So for section EA, they won't give us pencil.
No.
How we do?
Scrap paper. We have something called a scratch pad. If you want, you can use that.
That's pretty much useless.
You can. Better to use physical paper.
Yeah.
That's the easiest way.
Take it.
Take a calculator. You have a calculator provided on the platform. Don't use that. Difficult.
So the useless.
Difficult. I won't say useless, but difficult.
Useless. I never used it.
Let's check if you got 52,900.
So can you show the working for previous one?
Yeah. Let me go to that. Let them take this down first if they are not done. I think there's an answer for 52,902. I think that's the closest answer. 52,901, I think there's some rounding.
I mixed up the tax and did this.
Still zero.
I think I depreciated by the tax value and tax by the depreciation.
Only the first day will be correct.
First,
First day will be correct.
no, in the first year, no. Because
I didn't know.
0. Yeah, in the first year it was correct.
Okay. Finished. Okay, so you should have got 52,900 and 2. You got 901. We're close. Okay, sir. Mister. Doing. This you can remember.
So if the answer for 17,
Calculate the return on capital employed based on average investment for investment proposals. Yes, we did that. 30%.
38.
It is 30 to my understanding. Yes. Is that? Yeah. So this is 52,902, just like what we work now. Okay, look at number 19.
So why didn't you deduct fixed costs and stuff?
Where? 17.
Yeah.
I took total cash flow 100,000. Total cash flow I got from my working before 100,000. That is after deducting fixed costs.
So can't we do it by taking the NPV?
You need to calculate your cash flow, total cash flow, no? NPV is present, right? This. Which one? Number 17. Which one? You want the answer to 16? Okay. So in terms of 16, what happens is you have revenue of 8,000 into 45. That's okay, no? 360,000. Cost, variable cost is 8,000 into 28, 224,000. That gives you contribution of 136,000. Minus your fixed cost of 36,000, you get 100,000 per year as your net cash flow. Now this is per year. No? How many years are we looking at? 4 years. So to calculate your present value, take per year cash flow multiplied by annuity factor at 10% for 4 years, which is 3.170. So then you get 317,000. Minus the investment value of 250,000, 67,000 is your NP. Understood? The second one, they are asking you ARR or ROCE, one of the two. So, yeah. Your ARR is basically total cash flow, which is, or if you look at a formula, ARR is average profit over average investment. That's your formula. Average profit. Okay. So how do you calculate average profit? Take total profit divided by 4 years. What is your total profit? My total profit is cash flow. I have 400,000 minus the depreciation. Here my depreciation is equal to investment value. Why? Because there is no disposal. 400 minus the depreciation. So therefore, you get 150,000 as total profit. When you divide by 4, you get 37,000.
Why divide investment by 2?
Opening plus closing. Opening investment 250, closing 0.
Why would there be a closing?
Disposal. And we should divide by 2. Yeah. Okay. Which two of the following statements are correct?
B and D.
B and D. B and D. The discounted payback period for a project will be shorter than the non-discounted payback period. Wrong. Non-discounted will always be shorter. So discounted payback period for a project will be longer than the non-discounted payback period. Correct. If a payback period calculated is longer than the company's target payback period, the project should be accepted. Ideally, should not be accepted. Payback period is shorter than the company's target, project should be accepted. The end. Okay, quickly do the last one.
7.8.
I don't know. Do the last one.
Right, should be lower than the money market rate.
Cost of capital is 10%. General inflation is 2%. What is the real discount? Has to be
7.8. Right. So how much should we target for section A?
Section A 10
Out of 30?
minimum 10. Why? Because you already secured no 30 marks in section C, 10 marks from section A, 10 marks from section B, 50 marks you must. Simple. What I'm telling you is section C has to be power play. Hammer out of the park. 30 out of 40 has to come. In case that the exam something goes wrong and you feel like you are not going to get 30, catch those marks from section B. My duty is to get you across 50. Your duty is to take that 50 to 100. Each person has to play a role. No? My role is to push you to 50. Once you run at 50, my job is done. Okay. Complete the following statement. If the cost of capital is 10% and money discount rate and the general inflation is 2%, real discount rate is what? So here what you have to do, you have to use Fisher equation. 1 plus I is equals to 1 plus R into 1 plus H. So this is 1 plus 0.10 is equals to 1 plus R into 1 plus H. So then you compute what R is. So 1 plus R would be equals to 1 plus 0.10 divided by 1 plus 0.02. When you do that, what do you get? 0.1 divided by 1.02. Yeah, you get 1.078. So 1 plus R is equal to 1.078. R is equal to 0.07. So 7.8. Okay. Simple. Okay. Now I'll give you 20 minutes. Do section A quickly. 20 minutes for section A. Too much time.
Three paper.
Hmm?
You will do 3 paper.
Yeah, I can do 3 papers in 3 hours now. After teaching for 10 years. What do you want to say? என்ன பிரச்சனை? I said, come to 30 and you will realize what is life. Then when I meet a person who is 40, he will say, come to 40, you will realize.
So it's like the point.
What you're suffering today is better than what I'm suffering now at 30. When I talk to a person who is 40, they say, what I'm suffering at 40 is better. I love my 30 days. As you go, you'll get more problems. Problems won't reduce in life. Don't worry. That's why they say rest in peace. When you're dead, only you get rest.
So like we gotta say now, come to our age, you know, how stressful life is.
So when you come to my age, you will be.
So you come to our age and see how stressful.
Huh? I was in your age.
But that was in a different time. That's all.
When I was doing ACC, I was studying for my degree and I was working a job. I was doing a job also. I was doing 3 things at the same time. I think life could be more stressful than that.
What was your first job?
I was a finance intern at Virtusa. Finance, it's a IT. I didn't like it, so I did.
Did you like it?
Boring.
Bad culture or
The job was good. As an intern, no? I had to do fixed asset verification, to this, that, I had to help the audit team. Then I went to an economic research firm.
that was good?
That was okay. I survived 9 months.
It's like the most exciting or like fresher job.
Exciting fresher job.
Exciting, yes. Like,
It depends on what excites.
like nobody likes to do the same thing every day, right?
Some people like. People who work in hardcore finance reporting, they like.
Finish which question?
All the questions, 1 to 50.
My phone is.
Okay,
Yeah, one done.
continue.
With this type of question, like beta.
Not sure if it's sexually.
What do you call that type of question?
Again, capital structure. So, first question, I think that was straightforward. XYZ has a forecast of sales of 200,000 and predicts that sales will increase by 5% each month. All sales are on credit and 60% of customers pay after 1 month, the rest paying after 2 months. What cash receipts from customers will be budgeted for May? Give your answer to the nearest dollar. Ideally, you have to take March sales into 40% and 60% of April sales. Correct? So May will have 60% of March sales and 40% of April sales. Right? So in January you have 200,000. Yes.
May would have 60% of April.
Sorry. Yes. So this will be 60-40. So 200,000. Then Feb will have something more than this. So by 5% would mean 210,000. March 210,000 increased by 5% should give you, by 10% would mean you increase by 21. So by 10.5. So that will be 121. Correct? Or let's say 220.5. Then April. Sorry?
227.
No. March sale is 220,000.
We don't need to calculate sales, right?
No, sir.
Why?
Because you are getting any cash this month in March.
All sales are
So
credit.
January, 40% of January and 60% of February.
No.
All sales are on credit.
But that's what I'm saying. But cash receipt from customers will be budgeted for May.
Yeah.
So May it will be 40% of the March sale and 60% of April sales.
No.
Then
Yeah, we should not calculate the March sales, right?
why?
Because
So
all
they
are
get
on
the
credit.
March sales next month. March in April.
It is coming in cash.
No. What they're saying is you're in the month of May.
Yeah.
In the month of May,
No.
what cash are you going to receive?
Okay, hold on, sir.
Then
At a month of May, da.
So I was thinking March. My bad.
In month of May, you will receive
March and April.
previous month's sales cash and the month before that cash. So which means when you are in May, which is the 5th month, the previous month would mean 4th month. 4th month is April. So 60% of April sales you will receive in May and 40% of the 3rd month, which is March. And you got this wrong.
I took it as third one.
Okay, yeah. Okay, 220,500 into.
March.
This is how you lose 2 marks. This is 231,525. 231,525. Now calculate this as 40% to 220,500 plus 60% into 231,525. $138. Then 40% into 220 plus 227,115. Correct? You get 227,115. That's a basic mistake. Everybody will, except maybe him. What did you do? Same thing. Okay. What did you do, sir? Do something. I told you, no, don't do nothing. Don't give up. Correct.
For March, I do 3.
That's also okay.
No.
What? It will be.
April is 21 days.
So March will be 2. April will be. Which two of the following statements are correct? C and D. C and D.
A and D.
A and D.
A-E.
A and E.
C and E.
CNE. Okay, let's see. Economic risk in the exchange rate risk context is related to the problems of government changing the macroeconomic environment, inflation, GDP growth, etc. No, is wrong. Foreign exchange transaction risk in overseas trading relates to the problems of counterparty failing to fulfill obligations. Wrong. The forward foreign exchange market is in one which a deal is arranged to exchange currencies at some future date at an agreed price now. Correct. Spot market is in one which transactions take place and delivery always occurs within a few days. Translation risk obviously has to be correct. Occurs when the reported performance of an overseas subsidiary is distorted in the consolidated financial statements due to change in exchange. Ah. A company has agreed to lease a machine. C. For a period of 8 years with equal annual amounts at the start of each year. The NPV of the agreement at a discount rate of 10% is 52,000, ignore taxation. So in this case, your payment is coming at the start of each year, which means you're going to have NPV is equals to, how do you calculate it? What is NPV? Initial investment or present value of annual cash flows or annuity minus initial investment. That is NPV, no? Okay. So your NPV is 52,000. NPV of the agreement at a discount rate of 10% is 52,000. Okay. Present value of annuity. Okay. So what we can do here is, what you need to understand is the annuity, they're saying for 8 years, but you're starting in advance, which means the annuity factor that you're supposed to use is 10% 7 years. What is the 10% 7-year annuity factor? 10% 7-year annuity factor is 4.868, correct? 4.868 present value of annuity factor.
You take 10% 8 years and minus.
You can do that. Yeah. And then you can, no, that is delayed. You would add 1, not minus 1. 7 years plus 1. You can't take 8 years. That's delayed. This is advanced. So to this, you will have to add 1. So we add 1. So the annuity factor will be 5.868. So what is your value of the, what is the annual lease payment nearest to? So in this case, you can take 2,000. Huh? Yeah. 52,000 divided by 5.868. How much do you get? 8862. Okay. So here, I think what we have done is taken annuity factor 10% 8 years. You can't take 8 years because you are starting at the start of each year. Year 0, 1, 2, 3, 4, 5, 6, 7. So you have to take 7 years of annuity plus 1. It's an advanced annuity.
You are paying in year 2, it's in year 7. Okay. Then we should take the gap for years for the 7.
It's ending in year 7, you can take year 7 minus year 1.
To the year 7 minus 1.
Minus year 2, sorry. Year 7 minus 1.
It will come to year 1. Then we should again present into.
No. That is when you are doing perpetuities. When you are doing perpetuity, you divide by, let's say it's 10%, you divide by 10%. Then you come to year 2. From year 2, you discount back to year 0.
If it is annuity also, if we get the delayed one, it will come to year 1, right? Only 1 year will.
When you take the difference, you're okay. Now, can I just explain this quickly?
What he's saying is, it starts in year 2.
So we'll say you have years. You have year naught, 1, 2. Let's take a small example. 5 years. Okay. Now it's a delayed annuity, no? So it will start from here. Let's say $1,000 starting from here. Okay. If you want to calculate the present value, you can use, let's say, discount factor at 10%. This is 1. This is 909. This is 826, 751, 683, 621. Correct? No? These are the discount factors. And you can find present value. Technically, what are you doing? You are multiplying 1000 by 826, 1000 by 751, 683, 621. That's one way of doing it. Other way is adding up all of these 3 or 4. Right? When you add up these 4, how much do you get? Add and tell me. 751, 683, 621. Two one, 83 and 621.
2.88.
2.88. Now what you need to understand is, if you take the annuity factor at 5 years, if you go to the tables, annuity factor at 5 years is how much? 3.791. This is 3.791. Okay. If you apply 1000 into 3.791, your answer is wrong. Why? Because 5 years in the sense it's accumulating all of these years discount factors. That's only 3.791. That is 0.909, 826, 751, 683, 621. All 5 is 3.79. But your cash flows are starting from year 2. No? Which means from this 3.791, you need to remove out what you don't need. What do I not need? Year 1 I don't need. So I can minus 0.909. Now take the calculator, do 3.791 minus 0.909. 791 minus 0.909. 909. 2.88. That is the same answer as this. So technically what you're doing is, you're taking your year 5 annuity factor, minusing from year 1 annuity factor. That's it. No need to do anything else. This is present value only.
So
Nothing to do again, no?
can we do like this? Year 2 to year 5, the payments is paid for 4 years, right?
Yeah.
So to any factor 4 years, 10% 4 years.
You can do that also.
Zero
Is that how you learn?
into 0.909.
Okay.
That's why it's confusing.
That is confusing.
No. Now there is another. Actually, there-
What I tell my students is, I tell them logical things.
I'm paying attention this all the time. I mean,
Yes.
I was doing the other questions.
So what I tell my students is, okay, assume a normal cash flow like what I've drawn here. Okay. I'm not saying what your teacher told is wrong. It's a different way of doing it, right? But I'm a bit more logical. So what I would tell my students is, okay, this is your normal way of doing things. Okay. You know that there is no cash flow here, so remove that particular discount factor out. That's what I've done.
If it is from year 3, we should reduce 0.26 then.
So it's the normal way, right?
They have learned a different way.
So it's good that I didn't pay attention.
No, I didn't teach that method. I'm just teaching the method I taught you. Don't know. Clear now? Okay. 2 methods, you can do what you like. Examiner doesn't care, no? Yes, correct. Okay, number 4. A government funded fire service uses the 3E approach to assessing performance. Consider which, if any of the following are correctly matched to the elements. The average number of minutes taken to arrive at a fire is not economy. What is it? What should it ideally be? This has to be, this is effectiveness. Cost of maintaining the fire equipment ideally has to be economy. And this will be ideally efficiency. So this is correct. Only measure 3 is correct. Question number 5. The company is considering using a debt factor Which of the following services may the debt factor be able to provide?
Isn't that a matching question?
Which one?
Earlier.
It is. Not kind of matching. You don't have to match it. They are just asking which one is correct. So you'll have to just select this. Tick. Okay. Which of the following services may the debt factor be able to provide? Management of the receivables ledger? Yes. Insurance against irrecoverable debts? Yes. Why non-recourse factoring? Collection of debts? Yes. Processing customer orders? No. Advancing of credit? Yes. So 1, 2, 3, 5. T.
Insurance again receivable, right?
So non-recourse factoring is insurance against non-recoverable debts. If the customer doesn't pay, factoring agent to pay. QPR company has 10 million 0.6 par value shares in issue. It generated free cash flow of 1.6 million this year and expects this figure to grow by 6% per annum in the future. QPR company has a WACC of 10%. It has 600,000 of bonds in issue trading at 60 per $100. Calculate the estimated value of QPR company shares to the nearest cent. Didn't do? What did you do? You skipped? Why? Azmat, did you do it?
Skipped.
What mean? Estimated value of PCR company in share? In share?
Remaining time. So
You skipped this because of time.
went to the other ones.
Okay. So shall we do it then? Quickly.
Yeah.
Okay, sir. I'll give you a minute or so. Do.
So 3.6.
We don't have 3 points.
I tried it before, like 5 minutes.
That's a bond option. Okay. Shall we quickly discuss the answer? So done.
Your equity is 3.6.
Hmm?
Right. Value of equity
Yeah.
3.64.
Value of equity. How do you get 3.64?
10 million into 1 divided by 10 minus 6. Present value of
No, so here they are asking you calculate the estimated value of QPR company's shares. So how do you calculate that? So what I have done here is now they are saying generated free cash flows of 1.6 million. Okay. So using free cash flows, what can you calculate? You can calculate market value of the company as your free cash flows divided by WACC. Okay, that's the general equation. But here, this is going to grow at 6% per annum. Then you need to bring growth into play. 1 plus G, and then bottom says minus G. That's what you need to do. That's a standard equation. This is perpetuity.
only growth is minus.
Why? Huh? See, that's the problem. Tell me the dividend valuation model equation. Just tell me. With growth. P naught is equal to
Dividend 1 plus G KE minus.
okay. This is not perpetuity. Is this a perpetuity or not a perpetuity? It's a perpetuity. Then why did you put 1 plus T?
1 divided by R, right? Without growth.
Without growth.
If it is growth, 1
Hmm?
if it is growth,
Yeah.
1 divided by R minus.
Correct. So I'll tell you something. I don't know. You must have surely learned this, okay? When you look at a perpetuity, where is your standard starting point for a perpetuity? Where is your standard starting point? It's always year 1. Perpetuity assumption is you will always start from year 1. Now, why do you put 1 plus G here? Is because this value is a year not. So what you are technically doing, that's why we say D naught into 1 plus G is equals to D1. When you have D1, what do? You take D1 divided by KE minus G, correct? Understood? So logical answer to this is, to your question is, perpetuities always start from year 1. That is the standard arithmetic equation they have derived. If you are starting from a previous time period before year 1, you need to attach growth and find what the value in year 1 is going to be. That is why in this same question also, this year it is 1.6. You know. Does it make sense? Okay. See, if you don't, I missed out on the debt. So if you don't deduct the debt, you will get 4.24. The moment you deduct the debt, you get 4.2. So be very careful.
When did you deduct the debt?
Why do you deduct the debt?
I mean, when did you?
Yeah. This deduction of debt.
0.6 into 6.
Because this is the book value. I have to calculate the market value. Okay. So once you compute the market value, which is 1.6 million of free cash flows, you grow it by 6%, divided by 0.10 minus 0.06, you get this answer 42.40 million. This is the total free cash flows. From this, deduct the market value of debt to arrive at market value of equity. And then divide by number of shares.
Saying give like a time graph thing.
Yeah. Yeah.
Why the minus?
Why the?
Minus G.
Good question. I can answer right now. But when you look at a arithmetic series, you add, keep on adding. When you simplify it, it comes to this equation. That simplification I honestly can't remember. If you want, I will study and let you know. My math is very bad. He's asking how to derive this equation. Derivation last.
That's LGBT.
You can ask. Yes, he might be helpful. Okay. Right. TR company has a gearing level of 1:3. TP or TR is considering diversifying into a new market. This is what you asked for. B company is already operating in a new market. B company has an equity beta of 1.05 and a gearing level of 1:4 debt to equity. Both companies pay 30% corporation tax. Assume debt is risk free. What is the asset beta? How do you get asset beta? Simple equation, no? It's given in your formula sheet. Don't die over it. Asset beta is equity beta into value of equity divided by value of equity plus value of debt 1 minus T. Okay, don't try to memorize these things if you can't. Equity beta is how much now? 1.05. Value of equity, you have to look at
3.
that is the wrong.
No, 4.
You have to look at B company. 4 divided by 4 plus 1 into 1 minus 0.3. How much do you get here?
I got 0.89.
0.89. Okay. Check and see if you got the same answer. His answer, assuming the question answer is correct. Okay, sir. If I was saying okay, huh? The exam comes, results come only, I can see what is okay and what is not okay. No. They removed my name. You can go and check the timetable. The next batch is being done by some. No, FM next batch. Why? Are they going the 3-month thing?
So like only 3 subjects every 3 months. Who does they affect?
This time they have got some new guy. He's a student of mine.
Why
Suraj.
don't you do it?
Have time to stay at home and you will do AFS. Okay, consider the following statements. When the US dollar appreciates, US import prices will increase or decrease? Ideally, decrease. So this is wrong. When the US dollar appreciates, US export prices will increase, correct? When euro depreciates, it would benefit European exporters, correct? So statement 2 and 3. Which of the following are features of over trading? Good. Producing less than demand? No. Suffering greater risk due to frequent trading in stocks and shares? Nothing to do with that. Suffering liquidity problems due to growing too rapidly? Yes. Producing more than demand? No. A rapid increase in current assets? Yes. Okay. Red companies based in country H, where the functional currency is the H dollar. The spot rate to the euro is 5.5. Expected interest rate in the eurozone and country H are 2.5 and 6.5. But it's a forecast forward exchange rate. Use IRPT and quickly calculate. IRPT equation is given in your formula sheet. Last line.
5.342.
I don't know. I didn't calculate. So here you can take F naught is equals to F naught into 1 plus 0.025 divided by 1 plus 0.065. How much is this? 5.342.
So it's if not equals
5.55 into 1 plus 0.025. Huh?
Base currency.
How to figure out? So base currency, it's always where you have this $1. That's your base currency.
But in this
Yeah,
section, we should be confusing here with the symbols. Like
What? What is wrong with symbol? I can't help you. Okay.
they should answer this question.
Which one? Very simple, man. Consider which any of the following descriptions have been correctly matched to the source of funding in Islamic finance. Equivalent of lease financing is Ijara. This is correct. A special kind of partnership where the investment comes from one partner and the management of work is done by the other one is. This is correct. I got it also. Okay, so that is correct. Then a relationship between two or more parties which contribute capital to a business and divide the net profit and loss pro rata. Correct, no? Musharaka is venture capital.
Venture capital, but process of yes.
Loss pro rata. Huh?
Is debt finance.
Third one is? No, third one is venture capital, right? Relationship between two or more parties who contribute capital to a business. So Musharaka is venture capital. Murabaha is trade credit. Trade credit.
So I would have gone all correct.
Sir, what is debt finance?
Sukuk.
So pro rata means
Like para. Pro rata is equal. So if I have invested 20%, I get loss of 20%.
Well known in Japan. Keep this in heads.
Keep reading. Yeah?
Wow.
Divide the. A form of trade credit or loan, this is correct. All statements are correct. 12. Which of the following is a difference between primary and secondary capital markets? What's the answer?
C.
C.
Yes.
Primary capital markets relate to the sale of a new issue of bonds, preference shares, and ordinary shares, while secondary capital markets are a security trade after the initial offer. That's correct. A company has an interest cover greater than 1, okay, and gearing of 50%. Which to the following explain the impact on interest cover and gearing of issuing shares to repay half the debt? Interest cover will
Price.
increase ideally. No? You can pay more interest with the available profits because your interest portion should have reduced when you pay off debt. So A is correct. Gearing will fall. Simple. That's grade 2 question. Huh? You got correct?
no.
I'm sure you did read it. Which two of the following statements regarding dividend policy are true?
Is a bit confusing.
Confusing. Okay, let's see. All public companies are able to distribute up to 100% of retained earnings in the form of dividends.
No.
Are they?
Some other two seem correct.
There can be legal restrictions on this. Huh? There can be legal restrictions. Okay, so this is wrong. A dividend that is different to investor expectations signals information about the business to the investor. That is correct.
What does that mean?
Signaling effect. If I pay less dividends than I am expecting from the company, then I know company is going through some troublesome times. It's a signal. The dividend irrelevance theory states that shareholders prefer capital growth to cash dividend. Wrong. What do they say? They are indifferent. Indifferent.
Different.
Indifferent means they don't care whether it's coming from capital gains or non-dividends. Residual theory argues that dividends are important, but the pattern of them is not correct. A bonus share issue can be used as an alternative to cash dividend. Wrong. It's a scrip issue.
So it is right in some way.
Scrip issue, not bonus issue. An alternative form of dividend is called a scrip issue, not a bonus issue. Bonus issue is where you give free shares to reduce your share premium.
If 1 year the company pays a huge dividend, the investor will accept to receive same amount
Next
next
year.
year.
Yeah.
What's the
Dividend smoothing effect. Smoothing effect. Okay, consider the following statements. Monetary policy is exercised by a government by control over interest rates only. Wrong. Also, monetary supply. An increase in interest rates will reduce consumer spending. Correct. An economic policy goal of full employment could lead to excessive inflation. Correct. So statements 2 and 3.
finish?
Okay. I'll see you next week. Tomorrow. Sorry. And we'll do one more paper.
Any, so you told you're going to give a lot of tips for the exam.
Tomorrow is time.
No.
So you said there is a paper you can give us.
I'll give up.
Mock to do. In the pre-mock,
Tomorrow is free.
pre-mock, but we didn't do.
Huh?
We didn't like.
I'll let you know.
Everybody in the pre-mock.
Still deciding. I didn't do the pre-mock. I did the pre-mock.
We didn't.
Yeah.
We are done.
Is it easy?
Yeah.
Huh?
So pre-mock is I think afterwards.
Why? These are better.
I mean, supplement mock is good now. Like science, I give a couple of people really difficult.
These are Kaplan also.
And couple the final.
This is Kaplan.
And final.
So this is mock C, final mock is mock D. That is for tomorrow. So we'll do mock D then. But we'll discuss the pre-mock leisurely tomorrow then.
We're going to do two tomorrow.
Don't think we have time to do two, but we'll just run through the questions. I got this from PPIM.
I think, yeah.
I also didn't have it, only I got it yesterday.
Then today we will do this paper.
First time I'm doing it.
So if you like buy the book or something, they give a code to scan.
Huh?
If you buy a book or something, they give a code to scan. Then you can access all the short notes.
Yeah, I think
The mocks are.
mocks are there that I haven't checked it. I've always had access to these mocks somehow. Somebody gives it to me.
So we can give it for some.
Yeah, I can give it. There is mock A, B, C, D. I have discussed C now. I have D to discuss tomorrow.
Then in the
A and B again.
The A.
Mock I gave. Mock I gave was mock 1 now. So I did mock 1 with you. I gave the exam.
Yeah.
That was BPP. Mock 2 and mock 3 is again BPP. And now we have done mock C of this. So we have done 4 mocks. Tomorrow, that's what we did last week. Last Saturday, Sunday, that's what we did.
Not 2 and 3.
2 and 3 of BPP.
Mock A and
A. I'll try. I don't have mock A and B. I'll ask them to send it. Yes. You say something. You're looking at me. Okay, so shall we get started? So, just as we normally do, run straight into section C. Look at the 2 questions. The first question is about NPV, and the second question is on working capital. Right? So it's good. It's good. We cover these 2 questions quickly. So, what shall we start off with? 31 or 32? You all have to tell me. I'm okay with the ending. NPV? NPV, okay. So you start with the most confident question. So we're going to start with NPV. So question number 31. Okay. So let's read through. It says Forward Company is a small publisher and is considering to a project to publish a new book. The subject matter of the book is recipes that follow a currently fashionable diet trend, and the anticipated sales life of the book is 3 years. Okay. As Howard Company's printing presses are currently at full capacity, the company will have to purchase another press to print the book at a cost of 50,000 payable immediately, the start of Howard's financial year. Now, last time I told you, when they mention something like the start of the financial year, why is that relevant to us? I mentioned this last time to you. Why is it relevant? It becomes relevant because of what? The start of the Howard's financial year becomes relevant because of tax. right? If they had said at the end of the previous financial year, your tax allowable depreciation will start from T naught or year naught. Here they're saying it's the start of the financial year, so your tax allowable depreciation will start from T1. Okay. Make sure that you're always clear about the tax dates, right? Because if you get that wrong, there can be a problem. As the press will only be printing one book, it should maintain its value very well, and it is anticipated it could be sold for 35,000 in 3 years. Okay, so you can dispose of this factory at 35,000. Now don't assume that the sales unit is only one book and they're going to sell the sales for 35,000. That's not what it is. They're talking about the facility. Howard would like to set a price at which it can sell 150,000 copies of the book in the first year, 75,000 in the second year, 30,000 in the third year. The price at which these volumes will be achieved will depend on the book's popularity. Past experience has led the sales team to predict a 25% chance to sell the book at 1.9, 40% chance to sell at 2.99, and 35% chance to sell at 3.99. No inflationary prices will be applied over the book's life. Variable costs are anticipated to be 1.45 per book in the first year, rising at 3% per year after that. Now be very careful here, or mindful rather. This 1.45 has been commented or mentioned to be in the first year, which means you don't do 1.45 into 1.03. For the year 1, you don't have to do that. Why? It is in first year prices. Fixed cost will be 95,000 in the first year, rising at the same rate as variable cost in the second year, but reducing to 25,000 in the third year. So it will increase by 3% and then go down to 25,000. Taxation is charged at 30% and is paid 1 year in arrears. Tax allowable depreciation will be available for the printing press at 25% reducing balance, with the balancing allowance charge being given in the year of disposal of press. Working capital will be 20,000 needed to cover the first year's sales, but will reduce in line with sales volume and will be released completely at the end of the project. Okay. So we'll need to do a small calculation there to check how your working capital will change. Now what they are saying here is 20,000 is relevant for the first year. First year you had 150,000 copies. Then your second year you will have to reduce it to match 75,000. And third year you will have to reduce it to match 30,000. Now you have to be very careful when you're working it out. You have to divide by 150 multiplied by 75 for the second year, divide by 150 multiplied by 30,000 for the third year. Okay. Forward's real cost of capital, very important. Sorry? Yeah, but since you're putting it at the start of each year, so you'll have year 0, year 1, year 2, and year 3. Year 3 you release it. And its money cost of capital is 13%. Calculate expected NPV of launching the book and, very important, don't forget, recommend whether Howard should go ahead with the project. Okay, I'll give you around 10 minutes, start your workings, then I will start and then we can compare. the start of year one, so you can put it to any zero. The only reason that they say start of forward financial year is for tax allowable depreciation. Tax eligibility.
Then the savings start in year 2, right?
Tax relief will start in year 2. Okay, how is it going? Good. Finished. Whole UK. Speaking. I'm also going to start my workings. Have you all done this paper before?
But this will reduce in line with sales.
Yes.
What is it?
So your sales volumes are starting off with 150,000. So the 20,000 is for 150. Then you proportionate it, divide by 150 multiplied by the secondary sales. This is mock B 30. Lisa? Where is this? Reading from? Sorry.
Variable cost anticipated to be 1.45 per book.
Yeah.
And then after 150.
Yeah, it's same. Yeah. Normally it's increase. Normally it's an increase. But here it is proportionate to your sales volume. Your sales volume is reducing. Working capital also has to reduce. So you will invest. It will always be a refund from year one. In this case, it's a refund. Year two is a refund. Year three is also. The sense you draw back.
At the end of year three, both of them.
At the end, you will take the balance that is remaining. Yes.
Because requirements.
But they're saying at the beginning of each year. If you look at working capital, we need to cover first year sales. But this will reduce in line with sales volume and will be released completely at the end of the project. So here what you can do is you can assume working capital is starting off from year now, because you need the working capital at the beginning of the year.
Year one and relevant if you cannot use everything.
You can. I would not recommend to do that, because ideally the requirement is to invest it by the end of year. It's not wrong. I would recommend you to do this. Depends on how you have done it. Don't change because of me. That will be okay. No problems. The discounting at 13% to make sure that you read the tables correctly. How is working capital in year 2 6,000? So what happens is you are investing 20,000 in the first year. Then in the second year, you only require 10,000, which means from the 20,000 you can draw down another 10,000, and you are remaining with 10,000. In year 2, you need only 4,000. So because you need only 4,000, the balance 6,000 you can withdraw from your working capital. That is what is shown as your relevant cash flow. We okay or not? Yeah. So your requirement for working capital in year naught is 20,000. That is how much you require. In year 1, your requirement will reduce to 10,000 based on the calculation that we have done. Look at the formula bar: 20,000 divided by 150 multiplied by 75,000. Year 2, my requirement is only 40,000, right? And year 3, no requirement. So year naught, my relevant cash flow would be for me to invest that entire 20,000. Okay, so hope you have got. Yep. Boys, okay? Finish.
What's the variable cost per unit in year 2?
Variable cost per unit in year 2. I did it entirely together. So 1.45 into 1.03 into 75,000.
1.45 103 to the power 1, right?
So the power 1 is 1.03 anyways. Tell again. Okay. Just give me a second. Let me face problem. 1.03 to the power 1. Anything to the power 1 is equal to the same number. No? So when you say 1.03, now when you say 1. Okay.
Into 1.03 to the power 1.
Yeah, you get 1.49. Okay.
That's what only
You should multiply by 75. Then you get 112,012.5. You must have multiplied by the 150. Did you multiply by 75,000? Still you don't get the answer. Are you rounding up somewhere?
1.45 means 111,000.
You're rounding up. I suggest not to, because I told you we are using Excel. Don't round up. Are you showing your working separate? The same cell. Are you doing the same working that I've done here? You can see this working right here. The formula.
That one. I took the variable cost separately and multiplied.
That's what I'm saying. That's what I'm saying. You're typing 1.49.
Yeah.
That's all. Don't do that. That's fine. Okay. Yes, sir. How can I help you? Working capital. Okay. So working capital, what you need to look at is, okay, in year naught, that is end of year naught or beginning of year 1, I have to invest 20,000 in working capital. Then year 1, this amount will reduce. Why is it reducing? Your sales is reducing.
They have 10,000. They have mentioned.
They haven't mentioned, but I calculate. Here by formula, but can you see the formula? Okay. I have, so that's saying 20,000 is for 150,000. So how much will it be for 75,000? Half of that?
150 is the dollar.
150,000 is year 1 sales.
Sale only we must see.
So they're saying 20,000 is for 150,000.
Oh, 75,000.
How much?
Then the third year also like that.
Say divide by
year one we must hear.
year 1. 20,000 divided by 150,000 into 30,000. Even if you take 10,000 divided by 75 into 30, you get the same answer. Okay. Right. So I'll give you a few minutes quickly complete. We can then move to the next part. Don't forget to write that last statement which says net profit. The net present value is positive. You can say since the NPV is positive, the project is financially feasible.
In this question, they have straightly given the money cost, right? In some question, we should use the Fisher equation.
Fisher equation.
If we using, we should show that.
Yeah,
They have allocated mark for that.
they'll give one. Yes. Asma, should we take real, because we already have adjusted. Real is non-adjusted. Non-adjusted. Nominal is where you adjust. So you have already adjusted, so therefore you take only this one. Am I clear? Difference because you don't do that. Okay, look at part B. Part B is the good one. For 3 marks, I think they should have given you more than 3 marks. Calculate the sensitivity to a change in sales price of the NPV calculated in part A. Now, how would you do that? Calculate the sensitivity to a change in sales price. How will you do this? What is the sensitivity margin formula? NPV divided by present value of cash flows under consideration into 1. Now, what is your present value of cash flow under consideration in this case?
96. Sorry. The 3.0. 3.0.
What is 3 point?
Sales price.
Okay, sales price. Okay. When sales get impacted, what else will get impacted? That is the question. That is what we need to think. Okay, now they are saying,
We should take a
what?
for the sales price
Nothing, right?
because their price is very
That is sales volume. Okay. When you have sales volume being affected, yes, sales will get affected, variable cost will get affected. So contribution will get affected. But here they are saying sales price. Now when you say sales price is getting impacted, then what happens? Then what happens? What else will get impacted? What else? No, sales will get impacted. What more will get impacted? That's what my question. Huh? When you're doing sensitivity analysis, I have told him enough. And you must have been told by somebody else that under sensitivity analysis, one variable changes at a given point in time. So when you say sales price change, don't say that sales volume changes. That is under simulation. Under sensitivity analysis, if sales price changes, everything else remains constant. But a price change, a sales price change will obviously change sales revenue and will change what else is my question. Now when you said sales volume, you said sales will change, variable cost will change, therefore I will take contribution. That's what you said. I didn't say, you said. Correct? Okay, now I'm asking you the same thing again, but forget sales volume, sales price. If it is only sales, you say it's only sales, nothing else is going to change. If there's something else, you say, yeah, there's something else also. Understand my point?
It's only sales.
It's only sales. What about tax then? If your sales changes, tax will change. See, I'll tell you something, alright? What will ideally happen is we're looking at when you say tax, everybody is accustomed to taking tax on profit, correct? But nobody understands the logic behind why you take it on profit. Why you take it on profit is any taxable, any income that you get, any income that you have, any income that you have is taxable, which means you pay tax. Correct? Any expense, assume tax deductible expense, like variable cost, fixed cost. Again, tax deductible, which means you will save tax. What is happening? Income minus expenses, profit. On this profit, taxable, you pay the difference between paying minus saving. This is how much you pay. This is the logic of tax. I don't know if you have thought about it this way. Okay? But start thinking, this is how you have tax. The more income you have, the more tax you pay. The more expenses that you have, or tax deductible expenses, you can save tax. That's why people with money still borrow and buy. Right? Don't ever blame them to say they are not paying tax. They have found a way to save tax. They've understood this simple equation. Very simple equation. Right? Next time your tax lecturer brings a big book and says we need to study tax. Simple equation. Find ways of how you can save tax. Find tax deductible expense. Okay? Understood? Right. So when you have an income like sales, what will happen? You will get taxed. You will get taxed. So now put that into working. So you can say part B now. And we'll maybe copy down the same thing from here. They're giving you less marks because you probably can copy and paste like this. Huh? Oops. Okay, so that's your sales. That's your sales. On this sales, you will get tax. What I explained before. It's an income. Income means you pay tax. Every income you have, you pay tax. So how much of tax are you going to pay? Tax is being paid at 30%, but don't forget 1 year in arrears. So this is your tax you will pay on sales. Now you might ask me the question, why is this tax different to this tax? It is different. Why? Because I already showed you that equation before. Every time you have an expense, you save tax. Every time you have a sale, you pay tax. Basic, huh? Very basic. Understood? So with me. Sorry? How did I get it? Yeah. So this 139 is calculated on your sales at 30%. Ignored, correct. Now you find present value, so you discount, or rather you find net first, net revenue, right? So you can sum it up. And then you can discount and find present value. Okay, so that's your net revenue or present value. So this is your present value of sales. So which means your total present value is being impacted due to sales revenue is this, right? Total present value impacted due to a sales price change could be 481,790. Now I will calculate sensitivity margin. And you told me the equation is NPV divided by present value of cash flow under consideration. If you want to get multiplied by 100, you get 19 point. Okay, so your sensitivity margin is 19.9%, which means if your sales price reduces by 19.91%, your NPV will become 180. Understood? Clear?
September we are seeing sensitivity analysis.
Same thing that I've done here. Huh? But what you probably, I was not in your class, but what you probably would have learned in class, you didn't learn in class. Okay. What you probably would have learned in class is learned on the annuities. So it became easier for you to calculate your sensitivity. I don't know whether you read a question like this in class, but I think we did one. Do you remember? On the sensitivity analysis, question number 2. Similar thing. If you have access to my recording, just take that video. But that again, I think was annuity. No? Sales is annuity, and you have tax as annuity, but delayed. Check that video. Sensitivity analysis, question number 2. Okay.
Yeah, thank you for your message.
But there is another way to do it, right? Let me repeat that once. I think I used simultaneous equations or something. I use a trial and error method by copying. Don't do the copy paste method. The simultaneous, I'm not quite clear how you've done it. Okay, done. Take it down if you're not finished. Huh? Abdullah, done. Good. Problem. So sensitivity margin equation is your NPV divided by present value of cash flow under consideration. In this case, my cash flow under consideration is 481. Explain the limitations of relying on expected values for this decision and discuss whether the sensitivity analysis calculated in part B represents a cause of concern. So let's look at it. So limitation of expected values, obviously you can say is this is more of a one-off decision that they're planning. One book that they're planning to print for 3 years, one-off decision. For one-off decisions, using expected values is not the best method. You will use expected values when you have long-term decisions, not one-off decisions, recurring decisions, because expected values will always give you a long run average. Will give you a long run. Okay. So I'll quickly write down the statement that you can say. The project is a one-off decision. The project is a one-off decision. Correct me to your question. Is a one-off decision, and using expected values may not be the most suitable method. May not be the most suitable method. So I say the expected values assume an average price of 3.09. An average price of 3.09. 2.09. 3.09. 3.09. But in reality, the price charged would be either 3.99, 2.99, or 1.9. In reality, the price charge would be either 3.99, 2.99, or 1.9. That's the reality. Then you can say, if the book sells at 1.99, the book sells at 1.9. Can you do quickly one thing? Take 3.09 into 1 minus 19.91%. 1 minus 0.199.
2.4750.
2.48?
2.5.
2.5, okay. So we'll say that, can someone read the last sentence I said? If the book sells at 1.99, ideally the NPV will be negative. Ideally the NPV will be negative. And the project would not be financially feasible. Now you can't randomly write at 1.99 it will be negative. That's why I asked this question. Now I said the last sentence at 1.99 PV will be negative. You can't just randomly say at 1.99 it will be negative. So what I did was I did a quick calculation. I took my sales price of 3.09 into 1 minus my sensitivity margin. Which then says if my sales price reduces by 19.99%, NPV will become 0. So at this price of 2.474, NPV will be 0. Anything below 2.4, NPV will become negative. That is 1.99 below 2.4. So if it's below 2.4, definitely has to be paid. Understood? Clear? Okay. The next part is asking about sensitivity analysis. They're saying and discuss whether sensitivity analysis represents a cause of concern. Okay, you can say that. Based on the sensitivity margin, a price drop of more than 19.99%, a price drop of more than 19.91% would lead to the NPV being negative. Full stop and say this would mean a price below 2.475. A price below 2.475. A price below 2.475. You can open a bracket and show the working quickly. 3.09 into 1 minus 0.199. Right. So the working quickly. 3.09 into 1 minus 0.199. Price below 2.4, right? 474, 475 would lead to negative NPV. Would lead to a negative NPV. Would lead to a negative NPV. Would lead to a negative NPV. Full stop and say there is a 25% chance. There is a 25% chance that the price will be there is a 25% chance. There is a 25% chance the price will be at 1.99, indicating a 25% chance the project will be negative. Therefore, if it is likely that the book will be sold at 1.99, the book will be sold at 1.99. Book will be sold at 1.99. Then the director should reconsider the publication of the book. The director should reconsider the publication of the book. Okay, page 20 if it makes sense.
The selling price is 0.9, right?
Hmm?
The selling price is 0.9.
3.09.
It is reduced by 20 negative. What's that? You call that 90, 1.99.
This one. So you take 3.09 into 1 minus 19.9. Then you get your reduced sales price. If your sales price goes to 2.475, then you will have a negative FP.
25% the price will 19.9.
1.9. That's because if you look at your expected sales price, they give you 3, 1.99, 2.99, 3.9. 1.99, there is a 25%. 2.99, 40%. 3.99, 35%. So which means if your price goes below 2.4, there is a problem. But 3.99 and 2.99, there is no problem. If it goes below 2.4, which is 1.9, there is a problem. So there is still a 25% chance that you can sell your book at 1.5. That is the problem. Understood? Okay. Let's look at the next question quickly. We have spent too much time on the first one. Okay. Looks like the break will be cancelled today. Don't panic. This is life. Sometimes things get cancelled. Huh? Sometimes things worse than that also get cancelled. Okay. Right. King Hill. Let's quickly read. This looks like a very easy working capital question. King Hill company has been operating for many years and has developed a very efficient credit control team who has been able to keep receivable days at a level of 35. Only 5 days longer than the 30 days offered as a standard term to customer. Okay. However, the managing director has recently stated as the industry becomes more competitive, businesses are finding that having a more relaxed attitude to managing customer credit has enabled them to gain ground on their competitors. We are lagging behind them with regard to this trend and need to address it. As a result, we've been asked to investigate the impact on the company's finances of allowing the average credit period to extend to either 45 or 60 days. King Hill finances receivables with funding costing 7% per annum. Very simple. Current credit sales are 15.6 million. Within the receivables balance is an amount of 250,000 owed from a major customer who has an ongoing long-term contract with King Hill for regular fixed monthly supply of goods. Okay. Which contains a clause of payment in 30 days, which they always stick to. It is not anticipated change even if the overall policy for the receivables management change. They made a little more tricky. To try and mitigate the effect of the increased financing cost if the receivables policy is amended, the company is also looking to change its inventory management policy. It currently pays 10.2 million per year for purchase from items costing $34 each. Every time an order is made, 10,000 units are ordered with the supplier, and it costs $25 to make the order. Holding cost excluding inventory funding costs are 1.5 per unit. Inventory is funded at the same rate as receivables. Assume 365 days in a year. It's a good question, right? Assuming that the major customer continues to pay to 30 days, calculate the extra funding that would be incurred under both circumstances if King Hill company relaxes its credit terms to 45 and 60 days. Explain why this change may help King Hill gain ground against its company. Okay, I'll give you 10 minutes. No, you start. I don't know if you can finish. You can start. Last paragraph is finite. That is the part B.
Yeah.
Then you remove that out. Then you have the net balance. Based on that net balance, sales
New sales and new.
discounted
What is the your funding cost?
interest cost. The finance cost. It's a really good question. Hmm? Can't work. Yeah, not cost benefit, you just have to work the benefit part. Here it's a cost anyways, increasing from 30 days, 35 days to 45 days and 60 days. So have two columns, 35 days, of three columns, 45 days and 60 days. But you need to first calculate now at 35 days how much it is, otherwise you won't know. Sales. No, that also has to change ideally, because what they are saying is this 250,000 receivable balance person, he will always pay at 30 days. So you have to ignore him completely. You have to remove his receivable balance out. You will have to remove his sales also out. No. Receivables and sales are two different. Receivables is at a given point in time how much of balance I carry, my balance sheet. That I am carrying for 30 days. Equivalent sale value of that would be your receivable balance into 30 divided by 360. Then only get your sales value. So what will happen here is, we shall be calling the large customer or something, right? So large customer, what will happen is he will have, if I was to calculate all of this again, we don't need finance cost, but let's take the same thing. Okay, I know his receivable days are 30, correct? Do I know his receivable balance? I know his receivable balance is 250,000. But what is the corresponding sales value? So what you can do is take 250,000 divided by 30 into 365. So you get a 3 million sale from this particular customer. From this particular customer. Understand? Understand? So you're getting a 3 million sale from this customer, right? Now, when you are calculating the balance after this, you have to ignore this 3 million value. Got it? Okay, Mr. Kafir. Asmat, I hope I have answered your question. Aren't we supposed to only consider the large customer? No, we are not supposed to only consider the large customer. We are supposed to ignore him. Shouldn't we multiply by 12? No, we should not multiply by 12. But rather, calculate your total sales based on the 365 days, not 303, not 30 days. If it was 360 days, you can multiply by 12. Okay. Then you can calculate remaining customers. So from your total sales, you can minus this, and from your total receivable, you can minus this, divide each other to get your receivable days. To get 36.2 days for the receivables. Then you can calculate at 40 days and 60 days. the receivable balance. So here don't forget, you can't just simply calculate your finance cost based on this other receivable balance only. You have to compute it based on total receivable balance. Okay. So the other receivable balance is 1.54. Don't forget, large customer receivable balance is always be 250,000. Large customer. That is 250,000. So therefore, total receivable will be the addition of these two. And your finance cost will be 125,880. Okay. This is if you increase it to 40. What you need to understand here is I can't simply calculate it based on only the 1.54. Why? Because I need to fund the large customers receivable balance of 250,000 also. Okay.
So 45 days they want to be you. So it means
But they had 30 days, but you still have to fund these people for 250,000.
then at first why cancel?
That is because when I'm calculating this other receivable balance, these guys, the large customer is at 30 days, this guy is at 40.
The balance is
The number of days are, but both require funding at 7% each. You can either work it based on receivable balance or you can work it based on sales. Either way, you get the same answer.
Divide receivable.
Okay. And then you have to add the large customer. You can't ignore the 250,000 because that will also needs to be financed. No, you're not agreeing with me. Yeah, you okay? Understood. Asmat, I'm sorry, I don't know which one you're talking to. I mean, which one you're referring to? How did you get the receivable balance? Which receivable balance? If you're talking to the remaining customers, I've taken the current scenario minus the large customer balance. But that's actually not relevant because I'm using sales. Okay. You can do the same thing for 60 days. And 60 days you go to 162,000. So if you want, you can compute then the increase in finance cost under each option. So in this case, your cost is increased from 104,000 to 125,000. In this case, your cost has increased from 162 to 57,000. Already 36.21, again formula. I took receivable balance divided by sales multiplied by 365. The reverse of your receivable balance form. Happy? Understood? Right.
So every person likes it.
This is a good question that has come along. It's a good question. Okay, so they're asking you find out, right? I would agree with you 36.21 days. Why don't you agree? It's a formula. Stasma, I like the fact that you don't agree with me, but tell me why. Because the earlier receivable days was 35, correct? So large customer on 30, other customers at 36, average comes to 35. Average is 35. You can calculate and see once again. Okay. Yeah.
We had last customer 50,000 because of they also waiting. They also has a credit time of 30 days.
Correct. So you need to fund it. So you can't ignore it.
But sir, we should take it separate. Why are we adding that? Because 45 is
You can take it separately. Whatever happens, your interest rate is only 7%. Either you can edit, you can find. Now, for example, you can do this. You can do the same working. You can
Yeah.
copy this and paste it here. No problem.
15 days gap is there, 45 to 30.
Okay.
That 15 days gap was not included for 30 days that you see about.
No, because if you change this receivable days, okay, the large customer to 45. Just look what will happen. Huh? Your balance, receivable balance, will change not to 250, but it will be more than 250. So you take this into 45. 45 is zero. Is not a number. So let me copy paste. So now you take this, you multiply it by 45, divide by 365. You get can someone tell me the sale value that was here?
The large customer sales is 3,40,667.
Right, now let's assume you change this to 45 days. Okay, this to 45 days. Now what will happen is your receivable balance will change to 375. But again, that 375,000 you are still funding at 7%. Just that when your number of days increase, what happens is the cash that you are missing increases. Now, if you keep this for 1 day, then you need only 8,333 for funding. Finance cost, yeah. So at 30 days, your finance cost is 17,500. Yeah. We'll keep that aside 17,500. You can calculate for this 15,000 1.5 million at 45 days also at 7%. Then what do you get there? 108. This 108 plus this 17,000. These two together will anyways equal to 125. Understand what I'm saying? Right? So if your number of days increases, that doesn't matter. That will only increase your receivable balance, which will then result in finance cost increase. Understand? Because your receivable balance is at a given point in time. It's a balance sheet.
The finance cost increase the days,
If your percentage is changing based on number of days,
then it will
then your calculation. Okay, explain why this change may help K company gain ground against its competitors. Obviously, relaxing the credit terms would mean customers will like it because they have no longer credit periods, which means lower financing costs for them, and therefore they are more likely to do business with K company. Right? So let's quickly write that statement down. I argue that you have to make either the other sales and the large customer sales to one common receivable. Why? The question says 30 days and 45 days. So I don't understand that point of view. Sorry. Okay. Anyways, so we can quickly write down a statement there. You can say relaxing the credit terms.
we're going forward.
Days three. Why they ask? Explain. So we explain. Relaxing the credit terms for the customer. Relaxing the credit terms for the customer. Will be beneficial for them. Will be beneficial for them. And they now have longer credit period. Longer credit period. And therefore are more likely to do business with K company. With K company. Okay. Right, look at part B. Calculate the savings in inventory cost that would be made from moving to a system of ordering using the economic order quantity. I think we did something very similar yesterday. Similar thing yesterday. Correct? Why we did 20,000 units order quantity and then we moved to BOQ at 3,000 units order quantity. I remember the value also. You and I in the same class? Same class?
So here is the holding costs excluding inventory funding costs.
Very good, yes.
So is there
Include, right?
We should add it.
share it, right?
7%. Huh? Other holding.
And the inventory is the quantity, right?
Inventory is they're giving 10.2 million purchase at $34 per unit, which means it comes to around how much? 30,000.
We should take
So number of units you can take it as 10.2 divided by 30,000 units.
this into 30. It's into 7.
No. Your finance cost will always be $34 into 7 per unit. No need to mark up that.
Oh, okay, then that you
Okay. So I'll quickly work it out. I think you should be able to do it.
it will be 35 into 7.
Funding cost will be 30. Yeah, into 7
plus
1.45. Let's quickly work it out. Currency knowing what is it mean? Currently ordering 10,000 units per. So here purchase cost is irrelevant, right? There's no discount. Say 30,000 units, sir. That's the total demand. Sorry? But purchase cost is relevant because we are trying to finance inventory. That will come to holding cost. So let me work it out for you. So your demand is 10.4 million, 300,000.
It's 10.2.
10.2.
Sir, there will be a saving, right?
Let's see. Still working. 25 into. So ordering cost will be 750. Your holding cost, you have to include the 1.5. So Azmat, this is where you take the $34 purchase price. Not, you don't have to calculate P into D, right? Because you are calculating always holding cost per unit. So holding cost per unit would be this amount multiplied by average inventory, which is 10,000 divided by 2. You get 19,400. So total inventory cost will be 20,150. Have you got that? You can put it, but No need. No issue. They won't cut marks. There is no negative mark. So you can calculate your EOQ to square root 2 into C naught. C naught is cost per order, that was 25. Into 300,000 units divided by 1.5 plus 34 into 0.0. So you get 1966 as your EOQ. Okay. So then you can compute your ordering cost and holding cost again. I will round this off to 1966 rather. So you can't take 0.2 units, it has to be full units, huh? Don't forget. So 1966 you can straight away take it. So this would be 25 once again into 1900 into 300,000 divided by 1960. Ideally holding cost will also be the same, right? So this is total will be 7,629. So savings from using EOQ, you can compute it to be 12,520 or 20 rather. That is straight. Okay. Rounding. Okay, last part. Explain the difference between short-term and long-term working capital and the difference between short-term and long-term finance. The three different strategies that can be adopted when determining the types of finance, short or long-term, to use funding working capital. So 5 marks, 5 things you have to write. Let's discuss. What are the three different strategies that we can use to fund working capital? Three strategies. We have aggressive approach, conservative approach, and matching approach. So those three you write, 3 marks. Then you discuss long term and short term. Simple. Okay. So let's quickly write down an answer. You can say working capital can be financed. Working capital can be financed through long term sources such as equity or debt, equity or debt, and short-term finances such as trade payables and overdraft. Then you can say, next line, in terms of strategies, one of the following three can be used. One of the following three can be used. First one, an aggressive approach where the company uses short-term finance to fund both permanent current assets and fluctuating current assets. Then number 2, conservative approach. Where long-term financing is used for both fluctuating and permanent current assets. Fluctuating and permanent current assets. Third one, matching approach. Where short-term funding is used for fluctuating current assets. And long-term funding is used for permanent current assets. Okay. Let's read through and see if it makes sense. Okay. Happy?
So then 3.8 and
Sure. Very good. Come again.
the holding.
Yeah.
3.8.
Yeah. So what you do is you have the holding cost. Other holding cost is given as how much? 1.5. 1.5. Then your finance cost is 34 into 0.07. Your purchase price is $34 per unit.
That only get missing.
Now we move to section B. Right. Let's quickly finish off. Hope we can finish all questions today. So section B has 3 questions. I don't know if you had a chance to look at it. One is on valuations, one is on forex, one is on cost of capital. So we start with cost of capital quickly. Okay. So P company has a positive NPV project that it wishes to take on. It does not have enough cash available, so is looking to raise new funds. Directors aren't sure whether raising more debt will be reviewed negatively by the company's existing shareholders. Directors have enough cash to cover 1/4 of the project financing needs, but had been planning on paying much of this as next year's dividend. P company's current long-term financing consists of 18 million 0.5 shares trading at XDV of 1.65, 2 million 100% redeemable loan notes with a coupon rate of 6%. These are due to be redeemed in 5 years' time at a premium of 8%. Directors believe that the investors in this debt require a 4% return. The most recent dividend payout has been 0.15 per share, and 4 years ago the dividend was 0.09 per share. Corp tax is 30%. Calculate the current cost of equity. Okay, current cost of equity. Shall we quickly compute? How do we do cost of equity? Cost of equity is equal to D naught into 1 plus G divided by P naught plus S. Okay, so first thing, quickly find out what the value for G is. So they've told us recently we paid 0.15, previously we paid 0.9. That was how many years ago? 4 years ago. Minus 1, this will give you a growth rate of how much? So 0.136. So then calculate KE. So D naught is already given to you, 0.15 plus 136 divided by P naught. P naught is a XD share price. XD share price is 1.65 plus G 0.136. So obviously it can't be 13.6. It can't be 9.4. It can't be 9. It has to be 23.9. Without calculating, I'll tell you. Obviously, you are adding something to 0.13 point. Don't have to calculate. Okay. You have to find it. Okay. Do something quickly. Theoretical market value of P is redeemable debt in a perfect market to the nearest 10 cents. So how do you calculate this? Use the equation market value is equal to present value of returns. So here your returns are of two types. So you are going to calculate present value of interest plus present value of redemption. Okay. So what is your interest? Interest is always calculated on nominal value. So here your loan is 6% into annuity factor. Annuity factor of what? Here you're looking at at 4%, 5 years is 4% 5 years is 4.452. Okay. Plus present value of redemption. They are saying you are going to redeem it at a premium of 8%. So what you take is 100 into 1.08. That you multiply by your discount factor. What is your discount factor? At 4%, 5 years, you get 0.822, correct? 0.822. So work this out, how much do you get? What? Which one? Which one?
The market value, right?
Yeah.
This cost of capital may issue post-tax on the pre-tax.
Market value is pre-tax. Cost of capital is post-tax.
Then this will come under business.
It comes is irrelevant. Yeah. Technically speaking, yes. They can mix it and give you.
It is a higher.
No. IRR you calculate when you have to do the cost of debt. This is valuation of debt.
That formula is present value of return.
So ideally what you are doing is whether you are calculating cost of debt or doing valuations, equation remains the same. Do you want me to quickly brief you on this?
Yes.
Let me just add a page before this. So your standard equation, which you should recall, is market value of an investment is equal to present value of return discounted at investors required rate. Correct. Return. Okay. Required rate of return. When you are calculating business valuation, what you are focusing on is calculating the market value. When you are doing cost of capital, you are ideally calculating this required rate of return. The same equation, right? What this technically speaks of is this equation will give you a scenario where NPV is equal to 0. Okay. Why I say this is, if you put this out as an NPV equation, how do you calculate NPV? Present value of cash flows minus initial investment. When your NPV is equal to 0, then your investment is equal to present value of cash. This equation is the same as this equation. NPV is equal to 0 at what point? At time. So whenever you are looking at discounting and making these two equal, to find the present value such that investment is equal to present value of cash flow, you have to discount at IRR. That is why you find that. So which means your required rate of return, technically speaking, is your IRR. Because if you look at it logically, your IRR is a break-even point. Break-even point. So which then says, for an investor to be minimally happy, you have to at least break it. That is why we compute IRR. Got my point? Okay. Okay. 115.5. Yeah, nearest 10 cents, huh? Don't forget about 50. No, 10 cents. 50 here. Okay. Which of the following statements are then true? What's the problem, sir? What's happening?
You know,
Huh?
KD 1 minus.
Yeah.
okay.
So again, go back to this. When you say required rate of return, investor's required rate of return, it is always KD. Always KD. However, when you are working out the company's perspective, always understand company will benefit from something called a tax relief. Because of that, you calculate KD1. Okay. So company's perspective, you will always compute KD1 minus P. When you are doing a valuation, the valuation you can't do from a company's perspective. You have to do from the investor's perspective. That is why you always use KD. But when you are calculating a cost of capital, let's say a WACC is for the company. That is why you use KD1 minus P. Okay. Right. Which of the following statements are true? Issuing convertible. Yeah. So again, same thing what I used, present value of returns. So returns for redeemable debt are two types. One is you get interest payment up until maturity, and then you get redemption at the maturity stage. So redemption is your payback, capital repayment. So your interest will be for 5 years at 6%. So I've discounted it at the required rate of return. Here the required rate of return is 4%. So I'm using the annuity factor of 4% for 5 years. Here I'm using the discount factor 4% for 5 years. 50.
Then 100 into 100.
Yeah, because they are saying here you're going to redeem in 5 years' time at a premium of 8%. So which means it's not 100, you will redeem at something more than 100. How much more than 100? 8%. Which of the following statements are true? Issuing convertible debt may be seen as less attractive than redeemable debt by investors, and the company may pay out a higher coupon rate as a result. Issuing convertible debt is seen as less attractive. Ideally, no, it has to be more attractive. This is wrong, right? What's the problem?
Mixing this question with that question.
Issuing convertible debt may be seen as more attractive than redeemable debt by investors, and the company may pay out a higher coupon rate as a result. Is that correct?
Yes.
You will pay a lower coupon. Okay, so ideally this also will be same. Issuing convertible debts may be seen as less attractive than redeemable debt by investors. Again, we said before, it is not less attractive, it has to be more attractive. Issuing convertible debt may be seen as more attractive than redeemable debt by investors, and the company may pay out a lower coupon rate as a result. Using convertible debt instead of redeemable debt makes cash flow planning for the company easier. Easier or more difficult? More difficult. Why? It will depend on whether you're taking a conversion or not. So therefore, it has to be correct. Using convertible debt instead of redeemable debt makes cash flow planning for the company. So D and F. Yeah. Consider the following statements. The conclusion of the no tax Modigliani and Miller theory is that there is an optimal capital structure. That is wrong. The debt cost line in the chart of the M&M no tax theory is higher on the y-axis than that in the chart of the MM with tax theory. Correct or wrong? The debt cost line in the chart of the MMM no tax theory is higher than that of the M&M with tax theory. Correct or wrong? Why? With no tax, you are at KD. When there is tax, you are at KD 1 minus T. So,
Tax is high.
with tax is high. So this statement is correct, right? Sorry, without tax is high, which is correct. No, right? With tax means you are going to KD 1 minus T, which is a lower value than K.
The options.
That's KD. No, the graph shows you. This is your graph. No? Without tax, this will go up. This will stay constant. This will stay here at KD. With tax, this goes up. This goes down. This is further down at KD 1 minus. Okay. In both M&M theories, the equity cost increases proportionately to the level of gearing. Correct. The conclusion of the M&M with tax theory is that companies should gear up to 100% of debt. Not 100%. 99.9.
It's to be 99.
Okay, so second and third statement is correct. Which of the following statements is true about Modigliani and Miller theory regarding dividend policy? What did they say about dividend policy? Dividend theory is irrelevant.
Because if the shareholder wants dividend, they can sell the
Correct. So based on that, what is your answer?
A.
Ideally A. Shareholders are indifferent between receiving capital gain of their shares or dividend. Right? It's more like I am doing mock. You all supervise. Very good. Okay, now do the next question. Sorry, we are down. Okay, do 21 to 25 quickly. Your life for X quickly do. Easy, no?
Easy.
This is the FRN. This is not Foreign exchange. This is interest rate. What was the answer for 17? 17 was 115.5. Based on this computation we did. So do this. Let your girlfriend to wait for a bit. Yes. Tell me about. Question number 17 is what I am showing you because you asked me. Any other question? Hello. Okay, good. You can always unmute and ask questions. I might not look at the chat continuously. So the company has prepared a cash flow forecast that concludes that they will have a cash shortage starting in 3 months, ending in 5 months. Immediately put down what FRA you need. Okay, because when you look at it, you know. So what you can do is delete these FRAs because not relevant. No? Don't distract yourself. Don't distract yourself. Okay. And what are they doing? That they will have to borrow. Borrow means you will always use the higher rate. So delete the other rates that you do more. End of story. Now you're only focusing on one FRA, one rate. Very simple. Okay. Later, when a customer is due to pay that very large invoice, in order to cover this shortage, the company will borrow 8.3 million, and in order to avoid the risk of interest rate risk rising between now and borrowing period, the directors are looking to hedge. The company is due to make a foreign currency payment to a Japanese supplier in 2 months. The amount is 75 million yen. Again, 2 months time. Spot exchange rate is given. 2 months forward rate is given. Ideally, in this case, I think there can't be an NMH. Ideally, unless they want to use the FRA rates. Okay, good. Quickly do.
Sir,
Yes.
we start from 3 months, we go up to 1 to 5 months.
3 months from today, ending in 5 months from today, which means the borrowing is for 2 months.
March means
May. So borrowing is for 2 months. April and May. Sure. Question number 17 once again. Multiplied by the number of months.
Already this 4.9 per year.
Sorry, yeah, guys, there is small catch here. It says 5 months later. Thanks. Sent that message 5 months later, which means your FRA that you're looking at is 3.8. 3 to 8, correct? Because they say here, I thought I read it as ending in 5 months, but it says 5 months later, which means you are going for 5 months on. Okay, so make sure that you read the question carefully.
5 months later means the borrowing period is 5 months.
5 by 12.
5
Then why that 4?
Sorry,
2 months 4.
2 months forward is for this Japanese supply. That's a separate thing.
Okay, how to identify the 3, 5?
So they're saying here 3 months, starting in 3 months, which means third month, ending in 5 months later.
Means 3, 8.
3 plus 5.
When later in coming?
Then 5. B. B. I've got B. Everybody got B? B. So here you take 8.3 million into the difference between 4.9 and 4.6% into 5 over 12. How much we get? 10,675. Okay, so B. Do the rest also, then we'll discuss. Why no tax in Q17? Azmat, once again, here you are doing the valuation of the debt. When you are doing the valuation of the debt, it is from the investor's perspective. We take it as KD. Okay, finished. Okay. So consider the following statements. If the company were to use future contracts to hedge its interest rate risk, instead of an FRA, it would need to sell futures contracts now and buy them back later. That is correct. Whenever you are borrowing, you start off by selling futures contracts. The company could use interest rate options to set a floor to manage its interest rate risk. Ideally, you have to set a cap because you are paying interest. That's the problem with this. Not flow, it has to be a cap. An interest rate guarantee would provide a tailor-made hedge for the company. Ideally, yes. It's an option for FRAs. So 1 and 3 are your correct answers. 23rd one, you should have got 510, 204, simple computation, 75 million divided by 147, 510, 204. Hope you're okay. Yeah. 24th one, what type of risk is D company facing on its Japanese yen payment? Very simple, transaction risk. The theory that equates the difference between forward and spot rates to the predicted exchange in spot rate is known as what rate? Ideally, expectations theory. Good. Expectations theory. Okay. Okay. Quick one. 26 to 30. The directors of rolling company are considering making an offer to buy 100% of the shares in B company, a competitor. Financial information has been gathered on B company as follows: operating profit, interest, tax, ordinary dividend, preference dividend, share price at the end of the year, number of shares in issue. When using a discounted cash flow valuation, the directors of our company have a policy of valuing the value of business by assuming that the most recent post-tax cash flows will grow for the foreseeable future at a rate of 2%. A discount rate of 12% is appropriate for this valuation. Calculate the total shareholder return for 2027 or 17 or whatever as a percentage to one decimal place. Now, question is, how do you calculate TSR? TSR is change in share price plus DPS divided by P naught. Quickly compute it. Operational risk, which is measured by operating gearing. Fixed cost over variable. Economic risk is long-term transaction risk. Consolidation.
We should take the last year price, right? We take the difference.
So last year's share price at the end of the year is this year's share price at the beginning of yeah.
Already.
alignment issue. Sorry, yeah. Correct. Thank you. Sensitivity 3.4. P naught. Uh, 7.5. Exactly 7.5. They are asking to 1 decimal place. The round up. 5,
6.
4, 6.
So, can you divide by 3.42?
3.5.
3.42.
You divide by 3.42. Original chapter. P naught. Then you have to change it. How much?
163.
6.3.
6.
6.0. Okay.
The one.
1 decimal place. Okay, do the next part. So, actually, in this case, what would you do? They're saying to calculate the present value of cash flows from 2028 onwards using the director's assumptions. So what is the director's assumptions? Take the most recent post-tax cash flow and grow it by 2%. Very simple. So pre-tax cash flow, post-tax cash flow would be 1650 operating profit minus interest of 400 minus 375. How much do you get here? 875,000. So you get 875,000. Then you grow this to calculate your free cash flow. Yes.
The preference dividends.
Why?
Get the earnings.
Free cash flow ignores financing cash flows. So 875,000 into 1 plus 0.02 divided by your WACC is 12%. So that is 0.12 minus 0.02. You get here. Ideally has to be 8.9. Gut feeling. Obviously can't be this. Obviously can't be this. Has to be something between these two. I assume it is 8.925 roughly.
Yeah.
Correct?
You did the growth because of the perpetuity starting.
I did the growth because perpetuity is starting from 2028 and we have the value for 2027. Okay. Which two of the following are deductions that would need to be made to the operating profit figure to produce an appropriate earnings figure for use in a PE valuation? Earnings valuation? Yeah.
Deduction means it should be deducted.
Ordinary dividends paid does not have to be deducted because earnings is before ordinary dividends. This is not relevant. Preference dividend paid, yes. Ongoing capital cash outflows for replacement of non-current assets. Calculate earnings, that's not relevant. Then taxation charge. So B and D.
Collecting profit from the earnings, we should.
All right. To come from operating profit to earnings, what do you minus? Tax and interest. Preference dividend is also considered as part of your financing. Only difference is it's not taxed down. Let's go it. Okay. Which of the following statements about valuation methods is true? Which of the following statements? P valuation methods are theoretically the most robust. They use real earnings figure. Oh, most robust is what? What is the most robust method? Ideally, FCF, free cash flow. Best method. Using replacement costs in an asset-based valuation provides a value most useful to the seller of the shares. Ideally, not the seller of the shares, but the buyer.
Because buyer maximum price, right?
Minimum price. Buyer rate. Seller will want the maximum.
The replacement cost, right?
Asset-based valuations.
Only the seller accept the minimum.
Okay.
Replacement cost means buyer offer maximum.
No, buyer will say, okay, if I want to set up a new business, this is what I need to pay. Sorry, okay, you can say it as buyer maximum. In the dividend valuation model, it does not matter if the growth rate of dividends is larger than the cost of equity.
It is.
Ideally, it is. Why? Because in your bottom part of the equation, you are saying KE minus G. If growth is larger than cost of equity, this part will become negative. Okay, so D is the answer. Consider the following statements about efficient market hypothesis and behavioral finance. Volatile share prices contradict the efficient market hypothesis. They're asking which is true, no? Why?
Volatile price means the miscellaneous risk.
Volatile share, no, this is about efficient market. No? Volatile share prices contradict efficient market hypothesis. Volatile means it's just moving up and down. What does efficient market hypothesis say? Efficient market hypothesis says share price will move based on information. If the share price is just moving without information, it's in contradiction to efficient market hypothesis. Because in an efficient market, only when you release information to the market, share price will change. Right, so this is correct. Noise trading is where naive investors buy shares that have been performing well. Okay, let's keep that aside. Insider trading should not be possible in a semi-strong, efficient stock market. That is possible. So, which means, based on these answers given, 3 is wrong, 2 and 3 is wrong, 3 only is wrong. So, which means 1 and 2 is correct. And let's do elimination. They say you go with the wave or ride the wave. I say okay, this share looks like doing well, then you buy the same share, then he buys the same share. That's kind of noise.
Herding.
Herding is
They have been performing well.
no, that's what I'm saying. Noise is relative. We see. Like everybody is buying the share, so I buy the share. Like what people did with Expo some time back. I'll take a sorry. Okay, let me come back to that. I'll check it. 27 does not equate to the answer. Is it? Okay. Let me check. It does equate to the answer. 875,000 into 1 plus 0.02 divided by 0.12 minus 0.02. Check. It's correct, right? I'll check my calculator. Asmat? Maybe you forgot to put a bracket in your calculator. Okay. Let's move to section A quickly. Mind rest. Okay, quickly do section A. I'll give 30 minutes. 12 o'clock we'll start this. Do quickly. 30 minutes is there. 12 o'clock we'll stop. Equivalent annual cost?
No, no.
The what?
Early settlement discount.
Formula? Yeah, fixed rate. Huh?
What's the
Discount factor?
Yeah.
0.751. Check. Yeah. Okay. Finished. And you need 10 minutes to do all of these questions. We'll discuss. Finished all? Huh? In 5 minutes, I'll do it. Finish the questions. You're not done it, huh? Finish? All? 15. Okay, very quickly. Which of the following is an attempt to overcome issues arising from agents theory? Linking director remunerations to the goal of increased sales volume. Again, this won't work. Why? No, sales volume is not directly related to shareholder wealth increase. You can have a volume increase, but if it's not increasing profit, what's the point? Okay. Minimizing customer complaints. Again, profit issues or non-financial also you can say. Short-term cost cutting. Short-term is the problem. Therefore, D is the answer. Okay, a company is looking to replace its fleets of cars. The cash flow involved here is follows. So here you need to calculate the equivalent annual cost. So how do you calculate equivalent annual cost? Take your total present values divided by annuity factor. Okay. So present value here, the only tricky part was they had given you total maintenance cost if it is held for 2 years. So don't take 13,500 and multiply by 0.826. What you need to do is take the difference between 13,500 and first year's cost of fixed term. So make sure you have made that adjustment. So when you do that adjustment, second year you should only have 7,500 as your maintenance cost for the second year. So based on that, you get a total present value of 85,624. So not 600, no, 024, right? So when you take 85,024 and you divide by your annuity factor, what is this? 1.736 annuity factor at 10% for 2 years. At 1.736, you have to get 49,322. So they're asking you to the nearest $100, so 49,000.
What do we do? Tackle this?
Okay, step by step, how do we tackle this question? Okay, so let me just do it here. So question 2 says to calculate the maintenance equivalent annual cost, right? So EAC is basically your present value of cost divided by annuity factor. Now you need to calculate present value of cost. So your present value of cost, you can start maybe with year naught. You have an investment of 125,000. 125,000 into 1 will give you 125,000 itself in terms of present value. In year 1, your maintenance cost is 6,000. You're going to multiply that by 0.909. How much is that? 6 into 9 is 54. 54. So this is the cost. This is the cost. Then year 2, I already did the working up here. From the 13,500, you have to remove the first year cost. That will give you 7,500. So take 7,500 multiplied by 0.826. Again, it's a cost, so it will be negative. How much do you get? 6195. Then year 2, you have disposal of 62,500. How much is this? 51,625. Okay. So take the total, you get 85,024. Okay. Negative present value of cost. Then you plug that 85,024 and divide by the annuity factor. What is the relevant annuity factor here? We're looking at 10% for how many years? 2 years. 1.736. Then you get 49,322.
Basically, on 1 year cycle, we would use residual value
1 year.
and we would remove the maintenance cost.
Yeah, only 6,000 will use. Your
We
maintenance.
would use
6,000. And then you will divide by the annuity factor of 1 year, which is 0.909. Okay.
There are chance to economic benefit.
Yeah. So same formula again, EAB. So present value of benefits divided by annuity.
benefits would be yes, same.
Same thing, but will be a positive answer. Okay. Right. Third one. Consider the following statements. Diversifying an investment portfolio allows the reduction of unsystematic risk to be a minimum. Correct. The capital asset pricing, the statement is correct. The capital asset pricing model calculates an investor required return taking into account systematic risk of an average market share. It doesn't take an average market. It takes the specific share into account, right? So no. A risk-free investment would have a beta factor of 0. That's also wrong. So ideally statement 2 and 3 are wrong. They're asking you what is false. So statement 2 and 3 are false. A company has 65 million by nominal value of 6% irredeemable loan notes in issue at a market price of 105 per loan note. Annual interest amount is just about to be paid, which means your price is cum interest price. This corporation tax rate is 30%. Calculate total X interest market value and debt holders required return. So first thing you need to do is calculate X interest value. So take the market value minus your interest payment. You come to 99 as your X interest market value per loan note. So then calculate the total market value. So 65 million divided by 100, because each loan note is 100, multiplied by 99, you get 64.35. So one of the answers of C and D. Then calculate the return to debt holders. So KD is interest over market value. So interest is 6 over 99, gives you 0.606. It is 6.1%. Okay. Easy questions these were. A supplier is offered 1.5 early settlement discount for payments of its invoices. It's coming from this equation. KD interest over market value. Market value is 99, what you calculated, not given what you calculated. And then interest is 6% into 100.
That's also good.
That's what I said. Return to debt holder. No? Are they asking company?
If we ask a company, it will be 4.2.
It will be 4. Is that what you got?
I think it's different ways.
No, no. Okay.
My assumption is wrong.
In the exam, irrelevant. Here it is relevant. Okay. Right. A supplier is offered a 1.5% settlement discount for payment of its invoices within 15 days. This would be a reduction of 25 days from the current average payment term. The annual value of accepting this discount is assumed 365 days in a year. So here you have to use the annual equivalent benefit calculation. So 1 plus discount over amount left to pay to the power number of periods. So number of periods is 365 over 25 minus 1. When you apply the equation, you get 24.68. So that is 24.7. Because someone is giving you a discount, it becomes a benefit. Okay? Got that correct? Didn't do it.
The same form we will use for
Receivables at cost.
the cost of dividends. There is the benefit of taking this. That's it.
Yeah. Okay. Which two of the following statements about corporate governance best practice are true? The CEO and finance director should not be the same person. That is wrong. Ideally, CEO and chairman can't be the same person. All directors should submit themselves for election at least every 3 years. Correct. An audit committee should be formed containing of a mix of executive and non-executive directors. Wrong. Has to be only non-executive directors. At least half the members of the board should be independent non-executive directors. Correct. So 2 statements are there. E is also wrong. There should be inclusion of non-executive directors on the board to act in a managerial capacity. Wrong. Supervisory characters. Because non-executive directors can't be in managerial capacity. Then they become executive directors. Okay. A company has non-current assets with a book value of 25 million, a net realizable value of 35 million, and a replacement cost of 50 million. Also, current assets of 2 million, current liabilities of 0.5, non-current liabilities in the form of 10 million, due to be redeemed next year at a premium of 10%. The company also has 15 million nominal value of ordinary shares with each nominal value of 0.25. That gives us 60 million shares. Calculate the equity value per share that is most appropriate to an investor proposing to purchase the business as a going concern. So when you're having a going concern, best is to use a replacement cost, not NRV or book value. Yes.
Explain where book value, NRV, and replacement cost would be used.
So when you say book value, this is where you're paying the minimum price. Minimum price. So let's say you're having a business that's, let's say, winding up, selling off at book value is okay, right? Then net realizable value, again similar story. Let's say you're winding up, you can use a net realizable value. But when you're having a replacement cost, you're assuming that the business is continuing in the future and you want to purchase with a good price.
Mistake I made is I took 37.
Why?
Because I thought you were supposed to.
So in this case, you will do the adjustments of 50 million and add the current assets and minus the current liabilities, you get 51.5 million. Your long-term loans, don't forget to increase it by 10% because you need to repay that 10% also. So 11 million. So then you get a net asset value of 40.5 million. Divide by number of shares of 60 million, you get 0.675. Can I know the answers of 5 and 6? 5 is 24.7 benefit, 6 is B and D. Okay. Number 8, which of the following is not a principle of Islamic finance? C was the answer. Late repayment penalties are allowed. It is not allowed. Okay. Select the correct words to complete the following sentences. Achievement of full employment would lead to inflation because people have more income. Rapid economic growth could move the balance of payment towards the deficit because you generally import. Okay. Calculate the following, complete the following statement. It's about TERP, theoretical X rights price. So a company has 6 million shares in issue and undertake a 2 for 5 rights issue at an issue price of 3.5. So when you say 2 for 5, I've done the computation here. So you already have 6 million shares. You're going for 2 for 5, which means you're going to issue 2.4 million new shares. So your TERP would be 4.25 into 6 million plus 3.5 into 2.4 million divided by 6 million plus 2.4. Your answer is 4.04. Ideally, check and see. So you should have got 4.04. It is now the start of June and a French company needs to make a payment to a US supplier of US dollars 175 at the start of September. The company's bank has quoted forward rates of exchange as follows. Calculate the value of euros. So here June to September is only 3 months. So you can remove the 6 months forward out. Also you're making a payment to a US supplier. So you need to sell euros and buy your dollars. So when you are using the particular exchange rate, you will have to use 0.920. Right, so 175,000 into 0.920. Gives me.
Divide.
Sorry.
Divide.
So always don't memorize when to multiply and divide. Okay, very simple. You are given euros, no? Right? You are saying I have $175,000. Okay. How many euros is this? That's the question. No? Here they are saying euros 0.920 for $1. Cross multiply. Okay. If you are not comfortable with cross multiplication, think of it this way. $175,000 and you have euros 0.920 per $1. Right? So when you write it this way, if you multiply, this dollar and this dollar will get set off. You left it euros. If you divide, okay, by $1, what will happen? This will go up here, then you will get dollar squared. Mathematically wrong, no? So you divide. Depends on how you want to cross multiplication is best. Okay. Number 12, beta question.
Dollar is the strongest, right?
Dollar is the
Strong currency.
weaker currency. Because to buy $1, you only need 0.9 of you. Okay. Company A has sourced a proxy asset beta of 1.5 from company B. Important thing is it says asset beta. Similar area of operations to a new project planned by company A. Company B's debt to equity ratio is 1:2. Company A intends to use PPIM to calculate cost of equity to feed into a new weighted average cost of capital to be used in appraising the new project. Company's own debt to equity ratio is 2:5. This is not expected to change before or during the new project. Corp tax is 30%. Assume all debt beta is 0. Calculate an appropriate beta factor. They don't tell you equity or asset, but you need to know what you put into PPIM is always equity beta factor. So calculate your equity beta. Asset beta is already given at 1.5 from the question, highlighted. Your debt and equity ratios are given to you, 2:5. So equity is 5, debt is 2, tax is given 30%, calculate beta, get 1.92. Okay. Ma'am, okay? Investment appraisal is produced with sales revenue anticipated to be 50,000 in the first year, inflating 2% per year for the next 2 years. Working capital is needed to be at 10% of sales revenue to be in place at the start of each year. Working capital will be released in full at the end of the project. Complete the following statement. If the discount rate is 10%, the present value of the working capital cash flows for the appraisal will be how much? So I've done a small working here. So sales is increasing by 2% every year. Your working capital requirement is 10% of sales. So I've computed 10% of sales each year. And then I've calculated the incremental working capital that is required. So 5,000 investment in year 0. Then you need an additional 100 in year 1, an additional 102 in year 2. And final year you can take out everything. Discount it at 10%, you end up with 1,268.45. Correct. You only discount the working capital. 1,268.45. So they're asking to the nearest $100. So when you round this off, the nearest 100 becomes 1,003. So at the exam, be very careful when entering. A company makes a new issue of loan note. On which two of the following markets is this issue made? Obviously, it has to be capital markets and has to be primary market. Secondary markets, you can't do a new issue, and money market is short term. Consider the following statements. Forward contracts are tradable due to their standardized nature. Wrong. Future contracts only can be traded. Basis risk is the risk of futures contract value changing over time. No, it is the deviation from your spot to futures. Options provide extra flexibility compared to forwards and futures. That is correct. So they're asking you what is false. Ideally 1 and 2 are false. Okay. I don't know how much you got. Since you did the question early than me, can just check and see how much you got. Anything above, I would suggest anything above 10. But check and see. You don't have to tell me how much you got. And keep it as a secret. If you got anything above 10, it should be okay. Ten means 20 marks. Huh? No, didn't get 10. Correct. Okay, let's bring the benchmark down. 8 is okay. 8. You got 8 correct. Didn't get 8 correct. Okay. So that brings us to the end of this mock. So we have done 5 mocks now. Mock 1, mock 2, mock 3 done. Mock C, mock D done. 500 marks of questions discussed in class. Correct, no? Enough? 500 marks this time. How much you want? 1000? Right? We can have a session on Saturday if you require. I don't know if we need to. Huh? We need. You want me to come on Saturday? Next week Saturday? Let's see. I don't know. I might not be in Colombo because I plan to finish by today and dust off. But let's see. If I'm in Colombo, we'll do a session on Saturday. Otherwise, Sunday. One of the days. Otherwise, no need for both days also. 500 marks is done. No. Okay. Tips for the exam. What do? This will say don't plan your holidays too early. You're the one who told me you can't come next week. Audit exam on Monday, so can't come on Saturday and Sunday. Okay, anyways. Hope I'll see you. Tips for the exam. Sleep well. Very well. What time is the exam? 9? 5:30. Then till 4 o'clock sleep. Okay, what time is the exam? 5:30. Sleep. What time is your exam? You also sleep. Everybody sleep. Okay, don't sleep in the night. Sleep in the morning. Sleep. Wake up at 4 o'clock. Wash your face and go to the exam. Okay. Take a lot of water. Drink water during the exam. Only when you drink water, you go to the washroom. When you naturally forced to go to the washroom, go to the washroom, use a 5-minute break, refresh your mind, then come back again. Okay. My suggestion, like what I did in class, start from section C. I don't know if you are comfortable with it. I don't know if you see the benefit of starting from section C. But as you know, section C will take longer. In class, it takes us 2 hours to do section C. Right? But within the next 2 hours, we are completing section A and B both. It is 60 marks as opposed to 40 marks. So my point being, start with section C, finish off those questions, target minimum 30 marks out of 40. Minimum 30 has to be targeted. Right? Section B, then you focus again, your best question, try to secure 3 out of 5. Next best question, again 2 out of 5 and 2 out of 5. Then 3 plus 2 plus 2. You have 10, 20 marks. You have passed your paper before going to section. So, don't worry. You can pass. Okay? Then you go to section A. Section A has to be just a, remember this last 1 hour that we did, jollyfully. You've done the questions. You got almost everything correct. So, don't worry. Right? It's not difficult. Difficulty has to be out of the head. Stress, tension, pressure, keep at home, lock in your cupboard and go to the exam. Always wear comfortable clothing when you go to the exam. I don't have to tell you these things, but wear comfortable clothing when you go to the exam. Right? If you don't feel comfortable in jeans, don't wear jeans and go. Right? Wear a track bottom and go, no problem. Nobody's going to ask you what you go for the exam and came. Right? If you have a bag, if you don't like t-shirts like this, wear not a pajama. Right, but wear something more comfortable. Right? Always feel comfortable at the exam. One thing that I used to do is I used to have my hair also removed before the exam. Not bald, but cut it short. Why? Because no disturbance, very comfortable. How you maintain your hair like that. But, it's very comfortable. Right? How do you manage overconfidence? Do 3 more papers like this, and you might realize you don't know anything, then you will manage your overconfidence. But don't get demotivated at the same time, saying I don't know anything. Okay? So, right? Don't say I don't know. Say start with some questions. The other is your bedtime storybook has to be Kaplan textbook. Sorry, revision kit. Every day before you sleep, read at least 10 answers and sleep. How difficult is it to write 10 answers in only 10 pages? Right? So for now, put away the Instagram and the Facebook and the TikTok and focus on Kaplan. Okay? Your Instagram has to be Kaplan, your Facebook has to be Kaplan, your TikTok also has to be Kaplan. Okay? And read, eat light. Don't eat too much. Huh? When you're studying, you have to not eat too much. Coca-Cola juice every day till exam. You can find small fish, make soup and drink. Superb. Again, it will help your brain in the exam. These things will really work. Coca-Cola is very good. Every day have Coca-Cola. When you go home, on the way you buy some Coca-Cola and ask someone to prepare it. Or prepare it yourself. It's very easy. Wash the leaves, put it into the blender, press the button, it will blend and come as a juice. Put some salt. If you want, you can put a bit of onions into it and drink. It's tasty. Don't put sugar. Very tasty. Coca-Cola juice. Every day in the morning have. Okay? One glass of Coca-Cola. That's all I can tell you to do. Everything else is being done now. You know the syllabus. In and out. Cover to cover, you know the syllabus. You have done 500 marks of questions. Nothing to be afraid of. Okay? So when you go to the exam, feel relaxed. Relax. And sit and, do the exam. Okay? Don't worry. You'll get through. About next week, I will let you all know. If no message comes through, no class. Don't come here. One day I forgot to send a message saying no class. One fellow came. I told I'm not coming. Not there. So if I'm not sending a message, we are not having a session. Okay? Officially ended from today. But if I send you a message, you come back. Okay? I'll send a message in the group. He is responsible to tell you. Huh? Okay. Good work then. Thank you.